Welcome everyone to our September results review program. And now we've got Andrew. Welcome, Andrew.
Thank you, David.
I can remember you from last night. brief teaser, as it were. I'm sure many in the audience will remember that as well. And you've got a full session now. So what are you going to talk about then, Andrew?
Lovely. Are you ready for me to share my screen? Is that okay?
Yeah, you're very welcome.
Great. Okay. Right. Let me just get this set up and then we can talk about. Okay. Let's go. Let's start at the beginning, not the end. Can you see that and hear me okay, David?
Yeah, that's good. That's good.
Great. Well, first thing, thank you very much to yourself and Anne for inviting me to present this evening. Apologies to anyone that saw the preview last night. We got cut off a little bit halfway through, but it was only a teaser for tonight. So hopefully we've got better connections tonight. I'm delighted to join the Mello community. For those of you that don't know me, my name's Andrew Hollingworth. I run a business called Holland Advisors, and Holland Advisors does two things. It is the fund manager for the VT Holland Advisors Equity Fund, and it also provides research to professional investors, companies such as Fidelity, Templeton, who you may or may not know. We provide the sort of wholesale sort of research ideas that go into some of their fund managers. Before we start, I'm just going to do a quick disclaimer. I'm not going to read it all out, but just to say that this is not investment advice. It's not a promotion to invest in the funds that we run. And if you are interested in investing in the funds we run, please go and read the prospectus, which I'm sure you will all do. Before we get into the sort of main subject of the presentation, and I should, being a little bit hasty there, I should just go back and just explain the title of the presentation. The title of the presentation is Owner Managers and Scale Economics. And really what it should have said in full title, but it doesn't quite fit on the page, is the importance of owner managers and the power of scale economics. And that's what I'm going to try and talk through. But before we get on to that, I'm going to start where I always start with my presentations. And that is perhaps the sort of structure and the importance of what you look for when you're investing. And for that, we're just going to have a couple of slides that talk about the importance of knowing what you're looking for, and looking at some of my sort of structure of what I have looked for in the past and what I look for now in investing. And I think it is important to put a framework around things before we jump into those two subjects. So let's just start off with this quote. For anyone that's seen me present before, they will have seen this quote, and I sort of apologize and I don't apologize. I don't apologize because I think it's absolutely crucial. So I'm going to read it out. Choosing individual stocks without any idea what you're looking for is like running through a dynamite factory with a burning match. You might live, but you're still an idiot. Now, some of you might have heard it before, some of you may not have done. If you haven't, I think it's a great quote to give you an idea that you need to consider what you're looking for in investing before you start. And for those of you that don't know, Joel Greenblatt is a US investor with a phenomenal investment track record using a very sort of formulaic approach. And I think his use of that approach with the powerful returns that he produced give you an idea of what you can achieve if you do know what you're looking for. The reason why perhaps it strikes such a chord with me is because I spent 20 or so years between the ages of 18 and 38 working with the very best analysts and with and for the very best portfolio managers, diligent, hardworking people, a number of which, many of which achieved very good results, but a lot of which were just very opportunistic about ideas that came across their desk. An oil company one day, and biotech company another day, a bank another day. And that's not to criticize them in any way. They were just operating in the environment that they were populated in. But they didn't necessarily have a really strong framework for what they were looking for before an investment crossed their desk. And what therefore really struck me when I first really came across people like Buffett and Munger in my perhaps early 30s was that when I started to reverse engineer the stocks that they owned, there was lots of common traits. There were barriers to entry, there was high return on capital employed, there was moats, and all the stuff that you hear people talk about in these days. The more latter years, maybe 10, 15 years ago, when Buffett then famously talked about three types of businesses. He talked about the dream business, he talked about the compounder business, and he talked about the gruesome business. I won't go into each of those now, but we can discuss those in detail later on if need be, as a way to describe the different characteristics of companies that you want to invest in, and the third one that you want to avoid. Again, there was a common characteristics of businesses that you should look for before you start investing. This, to me, really sort of struck a chord and really helped me formulate my investment approach, 10, 12 years or so ago. So just moving on, how does that formulate the approach that I had and have got today? This sort of graphic brings that to sort of a little bit more up to date. So if you would have asked me 6, 7 years ago, what I look for in investments, I would say to you, I look for great companies run by great managers and want to buy them when they're at great prices. And in turn, therefore, I'm looking for businesses that excel at the 3 functions of operate, generate, and allocate. I.e., they're great operators in their field, they've got good market share, they dominate their space and their industry, they generate good returns on capital, and then they allocate the capital that the business produces efficiently, effectively, either by reinvesting in growth or by reinvesting in business or by buying their shares back if it's the appropriate thing to do so. What I think is also relevant to think about at this point in time is that the best investors of the last 10 years have clearly had a very defined process. So Chuck Akra in America, Nick Train in the UK, Terry Smith in the UK have all had a very clear process of buying sort of franchise businesses. And they have achieved successful and very good results in buying those businesses. Now, today it is very easy to copy that approach and assume that approach is the way to go. But today, all of the businesses that they would be buying are clearly in that right-hand circle. They're not where the X is because they're not priced like bad businesses. They're priced like good businesses. So I'm not dismissing or denying or disagreeing with the approach that those people have made. I think it's an excellent approach and a right approach, and one that Munger effectively laid the foundations for. But what I'm saying is, what should we do today? Now those businesses are more highly priced. So I think that agreeing that quality companies are good quality companies is something we should all do, but overpaying for them might limit your investment returns. So what I try and do is look for businesses that are good businesses when they're priced like bad businesses. But, there's a lot of people trying to do that right now. So as my investment approach is evolving, what I'm finding today is sort of different opportunities. And this is where we're coming into sort of the title of the presentation I want to give. Today's opportunity is perhaps a little different. And the reason it's different is because so many people, professional, knowledgeable, hardworking investors are trying to buy high return on invested capital businesses. As a consequence of which, you're unlikely to find value in that part of the market. So what I'm trying to find value today is perhaps in 2 areas, what I've called secular growth businesses priced to fade and depressed compounders set to recover. The secular growth businesses priced to fade, the secular growth businesses priced to fade are effectively the franchise companies that others are looking for, but maybe there's something wrong with them. They're in that point, they're in that point X on the previous slide. And in those today in my portfolio, there are 3 stocks sitting in there. There's Boohoo, there's Facebook, and there's Alibaba. Alibaba's only bought very recently. Boohoo, perhaps I've owned for a year and a half or so. Facebook bought this year. And in those, I am buying high return on capital employed businesses that I think are going to grow for a long period of time. But I think the stock market is expecting them to fade, and I don't think they are going to fade. But I only own 3. I can only find 3 anywhere in the world because most other businesses that have got growth and high returns are expected and priced to grow for long periods of time. They're not cheap. The second part is what I call Buffett's compounders. And this is a category that I think is perhaps underrepresented or undervalued in the stock market today. These are what you call put up more to make more businesses. They are more like 15 to 25% return on equity businesses, but where they are deploying 50, 75% of their retained earnings every year back into the business, but then making a 15 to 25% return on that retained capital. The power of that retained earnings is underestimated by lots of investors and they can be brilliant investments if purchased at the right price. Businesses that I own that sit in that category today are VP PLC in the UK, Brembo and Jet2, all of which were bought perhaps about 18 months to 2 years ago. A subset of companies that fall perhaps in the depressed compounders is what I would call scale economy share businesses. And these are businesses that are serial reinvestors, keeping prices low and deferring profitability into the future. So let's talk for a minute about the importance of owner managers. Franchises are hugely loved, as we have all agree, but also so are owner managers, but actually quite selectively. The stock market today loves the owner manager companies of Apple, Amazon, Berkshire Hathaway, and so on. But Mr. Market selectivity, I think, gives opportunities today. In short, Mr. Market likes smooth delivery of clean earnings and likes, nice, simple communication. Mr. Market dislikes mavericks, volatility, complexity, and any company that doesn't fulfill the sort of ESG criteria. However, if you think about outsiders, and any of you are familiar with the book Outsiders by Will Thorndike, but I've studied that book many times. I've spent time with the author. And when you discuss the outsider CEOs that have the outstanding track records that book talks about, often they have poor communications. Often they have complex accounts. And often the stated profit and loss is often low because the companies led by the entrepreneurs want to pay low tax. So that isn't necessarily going to throw up the nice, smooth projection of profits and easy communication that Mr. Market wants to see. The other thing I would get you to do as investors, I think, is to think very long and hard about the difference between what it takes to become head of a corporate organization, like a political organization or a large corporation, and what it takes to be an entrepreneur. Entrepreneurs turned left when everyone else in their life told them to turn right. Entrepreneurs don't suffer fools. Entrepreneurs aren't interested in polite consensus. Entrepreneurs like to get things done, and they're not interested in a smooth life. They're happy to do things at speed, even if things occasionally get broken. So then you need to think about how those entrepreneurs interact with the stock market. Well, they are really determined that if there's going to be an investment phase or a change in their business, that investment phase might have to be long and might have to be protracted because they want to make sure the business that is their business will definitely be right for the future. So a chief executive that's promised an investment phase that's going to last for 2 years has to make damn sure it's done in 2 years because his job depends on it. Equally, an owner-manager entrepreneur may be conflicted because he may be wanting to buy his own shares back in a share buyback at the time the share price is depressed, when Mr. Market is being negative about the company. Well, is it in his interest to explain fully just how optimistic and how bullish he might be about the outlook for the company? And then you need to think about the frustration of the decades and decades of being a public company entrepreneur who's been quoted, who's had thousands of idiots like me ask questions of them about short-term trading, about balance sheet items that might have been irrelevant, about how they're affected by Brexit or COVID or whatever else, all things that they might have felt were not relevant to their long-term business, and how that might have caused resentment or difficulty for them. So I think in short, I would just say you need to try and put yourself in their head and in their shoes. And only by doing that can you start to think about why the stock market might have a different interpretation of that business than perhaps that businessman might have. And the last thing I'd get you to think about, or as an example to think about that, would be an example of Frasers, which is a stock that we own in the portfolio. Frasers has its AGM tomorrow, which if my tank was full enough with petrol, I'd be going, but sadly it's not. This time last year, they had an AGM where they announced a staff bonus scheme that would kick in at £10 a share. The share price was £4.40 a share in December. And Mike Ashley said, I think the £10 scheme is too easy. It should be £12. Now, without doing any analysis on the company whatsoever, it is interesting that there is an enormous difference between a £4.40 share price and a £10 share price. At tomorrow's AGM, Mike Murray, which is Mike Ashley's son-in-law, is going to be given an incentive compensation scheme that kicks in at £15 a share. Now, you may or may not like that compensation scheme. You might vote in favour of it or against it. But again, it's very interesting that that kicks in at £15 a share against today's share price of £7 a share. So all I'm trying to get at is, we're very interested in the Mavericks when they're underpriced by the stock market, and when we get offered a lot of value to invest in them. We don't always do it, but we do it if we think the business is underestimated in the prevailing stock market at the time. But let's talk a little bit about scale economics. And if I run out of time, David's going to give me a prompt, but I think we've got a few more minutes to do this. We published a piece, or Holland Devices published a piece in April, and it's free on our website if you want to read it. And in that, we talked about scale economics, and we started off with a quote from Warren Buffett. Warren Buffett said, "I want to invest in businesses that are a win-win for the entire ecosystem." And by that, he means for society, for staff, for shareholders, and for everyone else around the business. We also noted in that piece a couple of recent events. One was Jeff Bezos's last letter he wrote for Amazon, and one was the Nomad investment letters. And if you're not familiar with the Nomad investment letters, I would read them. I think they're excellent. They were made publicly available in around December last year. To talk to Jeff Bezos's last letter, he basically wrote about the effect that Amazon had had, not just on shareholders, but on staff, on customers, on suppliers, and on how all the different people in Amazon's life, all the stakeholders, had benefited, if you like. And that is absolute music to our ears, because for many years, I've been writing about what I call EDP, or flywheel businesses. EDP being everyday low price businesses. Whether you want to call them everyday low price businesses, flywheel businesses, or scale economy share businesses, they are exactly the same. They are businesses that, as they get bigger, they give part of that scale back to the customer. So a lot of people in life and in business understand the economy of scale, and a lot of companies pursue economies of scale, but just not that many companies share the economies of scale with the customer. And what I'm interested in doing is investing in businesses that do just that. And, this is effectively, Munger talks about deferred gratification. If you can invest in businesses with deferred gratification, then you're going to sort of do well in life. There are two businesses in the world that are really well understood in this regard. One is Amazon and one is Costco. They both grow hugely. They both give away fantastic pricing and fantastic service. And the other thing they have in common is the stock market has understood them and has priced their shares accordingly for how good a business model they are. What interests me is there are lots of other businesses around the world that pursue a very similar business model in niches generally, but have not been necessarily rewarded, or are not always rewarded, for the power of their business model. And those are the businesses that I'm really interested in investing. It's so much so that about 35% of my portfolio today is invested in this sort of companies that could be defined in this way. What is it that I like about these businesses? Well, the future growth is more assured in these businesses than people realize. And the reason for that is because they've invested so much in the sort of customer relationship. They're impossible to compete with. And by that, I mean, in JD Wetherspoon's case, if you go into a pub in London, a pint of beer will cost you literally half the price of any competing pub. That is an impossible business to set up and compete with. Quite a lot of the best businesses, not all of them, but some of them at different points in time, are actually priced quite cheaply. And the reason for that is because something's gone on in the business, or the business is in an investment phase, or it's just a one-off stock in a sector that's not fully understood. So by that, I mean, JD Wetherspoon is the only low-price pub in the UK. AirAsia is the only low-priced point-to-point airline in Asia. And so therefore, the people that analyze the companies don't necessarily fully understand them. and profits are depressed, and therefore there are periods when those share prices do not fully reflect the power of the business model. The other thing I think is quite interesting is that the super high return on invested capital is not these businesses. They are more like the compounders I mentioned earlier on. They make 15, 20, 25% return on invested capital, and they keep reinvesting. And because of that, they are not necessarily coming out of the screens that the super high return on capital employed sort of franchise junkies want, and therefore they're not being bid up constantly the whole time. So let's just look at the slide you've got in front of you. So why, the reason I put that slide up as a sort of rhetorical question to finish with really is the sales on the right show that in the period of sort of 20 years or so, JD Wetherspoon's total sales have gone from sort of 400 million to 1.8 billion. Surely a business that has grown by that level of magnitude would have had positive operational gearing. But yet the operating margin shows negative operational gearing. Also, bearing in mind that the margins that the company is producing here, and I appreciate this is before Brexit, was sort of 7.5% or so, is 3, 4, 5, 7 percentage points below the nearest pub peer. So why is this company so unprofitable versus its peer group? And the answer is generally it's out of choice. The company has chosen not to put price rises through. The company has chosen to pay its staff well. The company has chosen to invest in freehold property. But at some point in its future, the positive like-for-like sales of more and more people visiting JD Wetherspoon will result in positive operational gearing. But that is not yet reflected in the profitability of the business, pre and post-COVID, and it's certainly not reflected in the share price. Last point I'll finish with, to reiterate, about 35% of my portfolio today is invested in these types of businesses, either scale economy share businesses. And to go back to the previous slide, about 90% of my portfolio today is invested in what you'd call either founder-led businesses or owner-managed companies. I think that's probably my time up. I'll stop there and be delighted to take some questions.
Great, thank you, Andrew. And we do have some questions already. Right, one of the attendees possibly missed a couple, but he says, what were the 3 compounders? I only caught Jet 2.
What were the 3 compounders that I listed? I do beg your pardon.
If he caught Jet 2, he's probably in Barbados now.
He might well have done. The 3 compounders that I'm sorry, I've slightly misunderstood the question. I'm sorry.
I think you must have mentioned 3 companies that you would buy, and he only caught Jet 2, or that you have in your portfolio. At the beginning, I think it was.
Well, I'm very happy. I mean, I own VP PLC, I own Jet 2, I own Wetherspoons, I own Ryanair, I own Fraser's. Exactly which ones I mentioned in which category, I can't quite remember, if I'm honest with you. I mean, obviously there is, some of the companies are compounders because they deploy more capital to grow more, and some of the companies are sort of EDLP businesses. I think other businesses we own in that area, just to help the person that's asking the question out, VP PLC is definitely one, Brembo's one, and Jet 2 is another one. So hopefully that gives him the list that he requires.
Yeah, I think it was that little group, VP, Brembo and Jet 2.
Cool, all of which we own.
Yeah. Now Yusuf says, please outline your thesis for buying Alibaba now. It's not an owner-managed company at this point.
No, it's not. Well, it has been for a very long time. And actually, you'll be pleased to know that when I gave my 90%, I excluded Alibaba from that 90%. And also on our website, if you want to read it, it's a piece we recently wrote on China, reflections on China. It's also on the Twitter feed. And also we just made free a piece we wrote for institutional investors on writing specifically on Alibaba, which we wrote in June. That's now on the website for free as well. And that was written at $210 and it's $150 today. So, you can look a lot smarter than I was. Why, in short, why did I invest in Alibaba? I mean, I did a lot of work post Munger buying into Alibaba. I'm not someone that knee jerks following somebody else. I do look at what a lot of smart investors do around the world, and a lot of the time I just look at it for a few days or an hour or so and shake my head and go, not for me. But I did a lot of work on Alibaba and a lot of work on its competitor Pinduoduo in China. And what struck me about them was not the fact that what I didn't know about them, which is lots, which is politics, geography, local competitive pressure. There's lots and lots and lots of things I don't know about these businesses. But what did struck me was what I did know about them. And that comes back to what we've just talked about, is that if you study Alibaba for any length of time, if you just read the first 40 pages of its report and accounts, or you skip through its slide presentation, it is a scale economy shared business on steroids, as are a number of businesses in China. Not all of them, but a number of them. And Alibaba is perhaps one of the best and one of the firsts. If anyone wants to understand Alibaba, there's a great YouTube video called Crocodile on the Yangtze, and it's all about the history of Alibaba and Jack Ma and how he developed Alibaba. But what it's really powerful in is just how much it invests for businesses that have yet to make a profit, for businesses that, you know, establishing market share position. So it makes Amazon look small in terms of its market share position, and it actually makes Amazon look relatively weak in terms of the scale and power of that it invests for the time frame it wants to get paid back on. So for me, what was really interesting, and is still really interesting about Alibaba, is that I have an unbelievably powerful business, you know, which is sitting atop an unbelievably, or potentially still very strong economy that is, because of all the fears of political intervention, being offered a really, really unusual price. Now, the reason it's such an unusual price is because people are terrified of going back to communism and back to state control and all the rest of it. But, you know, as Buffett famously says, you know, you pay a high price for a cheery consensus. And I wasn't spending any time at all on Alibaba a year ago when it was twice the current share price and everyone was very bullish on China. I'm now more interested in being a little bit more open-minded about these sort of companies when everyone is very negative and the value being offered is compelling. I don't think it'll ever be a huge percentage of my portfolio, but I think if things do not go as badly as the doomsters are predicting, and if capital is generally allowed to flow normally and economies allowed to carry on growing as would be good for China generally, then these businesses could be phenomenally valuable in the future. And that is what I'm interested in and all I'm really expecting to happen. But I accept that it is a company that I'm always going to have limitations to my knowledge and control over, which is why it'll always perhaps be a limited size holding for me. Yeah.
Now, John's mentioning here, did you ever look at Supreme, a recently listed owner managed business that I believe
it has been mentioned to me, but I'm afraid time has not yet permitted for me to look at it. But it has been mentioned to me, and I must look at it and make the time to do so.
Okay. And John's asking, thanks for an interesting presentation. Can you talk about Belvoir?
Well, I can, but it'll take a very long time. It is the largest holding in the fund, so I understand why the question's being asked. I'll talk about Belvoir by way of going back to the owner-manager thing earlier on in the Mavericks. There's a gentleman called Henry Singleton that ran something called Teledyne Holdings, which a number of value investors sort of hold up as having a better track record than Buffett back in the 1960s. And everyone says, look at his per share value per growth. If you research the history of value investing, Henry Singleton comes out sort of, right at the very top. What isn't mentioned about Henry Singleton when you read the books of his life is that he was a pretty unpleasant man when it came to liaising with investors day to day. So he bought his shares back when they were very cheap, and he issued his shares to buy other businesses when they were very expensive. But he didn't spend his life wooing investors and cuddling them and telling them how cheap or expensive his shares were. He wasn't like Buffett. He wasn't like Simon Wilson or something at Next. And Belvoir Holdings is a little bit like that. It is a business that I think the person that's running it is a phenomenal moneymaker, and I think if you read about what is said about him in terms of blogs in the US investment community, you'll think I'm mad. If you don't do that, and if you just print out the report and accounts of the company and you read them in turn, and you spend a careful amount of time really looking at things like the shares in issue in the company and analysing the company properly, I think you might see what I see at the company. And that's a business that I think is worth 3 times the current share price. And then after that, I think it will still compound at 15 to 20% per annum.
Great. Well, thank you, Andrew. That wraps it up, I'm afraid. A lot of questions, but it's really good to see you, and you've certainly been engaging, so that's good for all our audience. We've now...
Thanks for your time.
We will bring you on again, I'm sure, over the coming months. It'll be good to see you again. Thank you. Okay, well, we've got our first company presentation now. Welcome, Matt.
Hi, David.
And David as well. Welcome. And Neil. Excellent. Great. Full house. Well, Fintel, a company who have been to Mello a few times and in the physical world when we had proper conferences, but in the virtual world, we've got a chance to see all of you in one go, so that's good. And you've been up to quite a bit, I think. You've probably got quite a bit of news to tell us.
Yeah, it's been an incredibly busy first 6 months of this year, and yeah, we're delighted to share our interim results presentation with the Mello audience. And included in that presentation is a really high-level view of all the great things we've been up to. So
great. Well, over to you. Yeah. Excellent.
Super. Let's make sure this screen share works properly for me.
Yeah.
Okay, David, can you see the screen?
Perfect. Perfect.
Good. Okay. And good evening to everyone who's watching and tuning in. My name is Matt Timmins. I am the joint CEO of Fintel. I'm delighted to be joined today by my co-CEO, Neil Stevens. Neil and I have run the business as joint CEOs for the last 11 years. And we have recently been joined by David Thompson, who's the new CFO to the business. David joins us from Smart Metering Systems and brings with him a real strength and experience to the board. So we're delighted to welcome David Thompson on board at Fintel, and this will be his first presentation to the Mello audience. So welcome, David. I know you will introduce yourself more formally a little bit later on. What we're going to cover today very quickly inside the next sort of 20-25 minutes is a quick overview of the last 6 months, what we've been up to, the strategic progress that we've made. David will then come on and cover a financial review. And then Neil will pick up at the end and talk a little bit about some of those items of key strategic delivery throughout the first 6 months, and then finish by talking about the trading and outlook. So for those of you who are relatively new to Fintel, haven't seen us before, or for those of you who'd simply like a quick reminder, we are a fintech and support services business. We sit right at the heart of the retail financial services sector. The retail financial services sector is an incredibly large sector. It works incredibly well for consumers. There are thousands of different financial products that consumers can choose from, and they're offered at a price and value which is very competitive, and they're offered by some of the best brand names in the market. However, the market is highly fragmented. It is a very competitive market, and we sit right at the center of that, helping people within the market to do a better job. So we have essentially three customer types. We provide services to product providers, those people who manufacture financial products, to consumers, and then also to this huge fragmented intermediary market. So around about 80% of the sale of all investment business and 75% of the sale of all mortgages go from a product manufacturer to a consumer via an intermediary of some description, whether that be a financial advisor, a mortgage broker, a wealth manager, an aggregator, a consolidator, or whoever that may be in that intermediary sector. As I say, they control roughly 75% of all mortgages and 80% of all wealth and investment products. So very quickly, as a very quick overview, our role is to inspire better outcomes for the three customer sets that we support. And the outcomes that we are trying to drive is to help product manufacturers to build and design better products through the provision of data. and to help them distribute those products amongst this fragmented intermediary market. For intermediaries, our role is to help them run a compliant and successful business through our regulatory knowledge and IP, whether that be a relatively small business or whether that be a large national business. We provide support services to those organisations. We also provide them with a piece of fintech, a financial planning system that sits right at the very heart of the business. So when a financial advisor or a wealth manager gives advice to clients and they use our fintech, they input details in there about the customer journey. They put details, demographics about the client in there. They put information about the client's attitude to risk, and they go through a whole financial planning process with the client. So the data and information that we have on an aggregated basis around client preferences and advisor behaviour is really rich and really large. Around £37 billion worth of transactions flow through our fintech each year, giving us this massive data set that we can analyse on an aggregated and non-personalised basis, which helps manufacturers to understand what consumer preferences are and consumer choice. It helps manufacturers understand where their products are being selected, and if they're being deselected, the reasons for that. And then we help consumers make better informed decisions by providing a de facto rating on financial products. We research over 30,000 products in the UK, and we're able to help consumers understand the relative difference between two bank accounts, two general insurance policies, whatever it may be, and help them make better informed financial decisions. In terms of the first 6 months of this year, we have traded well. We have delivered a solid and robust financial performance. Our revenue is up 10%, our adjusted EBITDA is up 12%, and our margin stepped out by 60 basis points. We are an incredibly cash generative business, and we've used that cash along with the proceeds from a couple of disposals to pay down the debt that we took on when we acquired De Facto in 2019. So David will talk a little bit later on about that debt pay down and about where we are in terms of our balance sheet as we stand today. We've also accelerated our digital journey. We have built a new product provider portal for our manufacturing clients where they can go online, they can access data, and they can access distribution. And this helps move that part of the business over from what was previously annual repeatable contracts into long-term monthly contracts for data and distribution. Our fintech recommendations have grown to 37 billion as an annualized run rate. And this year as well, in the first 6 months, as well as rebranding to Fintel, we have also disposed of a non-core asset, Zest, an employee benefits business that we sold for 10 million initial consideration, representing a 22 times trailing EBITDA. We've also created a partnership with Tandem Asset Management, which Neil will come on and talk about in a bit more detail. But essentially that partnership gives us the first big enterprise deal in terms of our fintech. Tandem have essentially taken our fintech product and are offering that product out to their client base. That will increase our customer base by up to 30% and is the largest fintech deal that the company have done. So that's hopefully a quick overview of the first 6 months and what we've been busy doing. I'll now pass on to David, who will take you through in a bit more detail how those endeavours have manifested themselves into the financial performance. So over to you, David.
Thank you, Matt. Again, I reiterate the pleasure in delivering my first set of results for Fintel, and probably just give a bit of context and background to joining Fintel from Smart Metering Systems. You know, again, Fintel's got a lot of hallmarks of quality here, a highly profitable cash generating business. The business model's also been proven to be very resilient and withstood very well the effects of COVID-19, particularly last year. It's got a real scalable platform to grow through digitization, and there's 4 ways that we can control and grow the bottom line, which I'll come on to in a slide, in a couple of slides time. And again, demonstrates the strategic intent. It walks the walk, as we've seen with 2 really important strategic transactions delivered in the period. So Matt, if you could kindly continue to drive over onto the next slide. I walk through the income statement. So as Matt said, there's double-digit growth throughout the income statement, 10% on revenue, 12% on adjusted EBITDA, and 12% on adjusted PBT. Again, that's off a really resilient base for the prior period in 2020 in terms of its COVID resilient operating model. Now, what's really important here is not just double-digit growth, but how that translates into cash generation. And on to the next slide, you'll see the profitability doesn't quite fall through to adjusted EPS because, and I'm sure you've seen this with a number of other investments or companies you're looking at, you may have. There's a one-off tax charge that's non-cash in the period that relates to the increase of corporation tax from 19 to 25%. And on a constant tax rate basis, you would have seen the adjusted earnings per share grow to 5 pence. And again, that double-digit growth would flow through to an ability to return to shareholders. But cash flow is most important here. Now, there's a slide later on that shows the breakdown of this, but we convert cash from adjusted EBITDA to a post-tax basis. So a 19% tax rate, you can see that 81% is the largest conversion amount we can have, all other things being equal. So, and again, previously we had some CapEx in the prior year and it was still 65%. So a strong sort of full cream adjusted EBITDA to post-tax cash flow conversion. And really how that manifests itself is a business that's able to invest to grow, but control its leverage. And you can see in the prior period, 1.5 tons that come down to just under 0.9 tons at the end of June. And if I pro forma the additional £13 million of cash that came in on the back of the two transactions, the sale of Zest and the Tandem partnership, that would be below 0.2 tons on a pro forma basis. So again, and we would forecast that the business, all other things being equal in the second half of the year, would return to a cash positive position. On to the next slide is really where we can demonstrate these 4 areas of growth. And again, one of the key attractions for me to join the board and the management team is we've got our 3 operating segments. Now, you take each one. So revenue, we can obviously increase our membership base, increase software, fintech and research licenses, etc. And we can grow revenue, we can grow the top line, and you can see strong growth in each of the 3 segments. We can also digitize and make efficient the current cost base. And that's not truly about just cutting costs, that's about making the cost base that's already there more efficient for growth, adding some reg tech into the intermediary services, for example, that the same amount of physical headcount and file checking and compliance, for example, can get a much broader reach to a higher number of members on the back of adding some clever tech into our sort of auditing function there. We can also control the margin by controlling infrastructure and support costs, that 3rd bullet point down, and that's where we get a lot of our operational leverage from. That's where the core IT sits, the other central shared service functions of the business. So again, as we present it in this way, so that as shareholders and other stakeholders, you can hold us as a management team accountable on a number of levels. We're not just aggregating it into an EBITDA margin number that you can see accreting over time. You can hold us to account on our revenue growth, the quality of that revenue. You can see it by segment, and you can also see how well we're doing in terms of cost of goods sold leverage in terms of the gross margin and digitization. You can also see how we're controlling that infrastructure and support cost layer, which is an inflation plus type cost. And key for me in terms of the 4th part where we can really add value is revenue quality. And that's in terms of our SaaS and subs percentage of our core revenue. So it's one of our longer term stated goals that we'll have between 70 to 80% of our core revenues as this strong repeating license software as a service subscription type revenue. And the key benefit to value there is its stickiness over time, and it's the clarity of cash flows out into the future. An example of that being the Tandem partnership, where we've secured 1.4 million of software license income for a de facto Engage product for a minimum of 5 years, with a chance to upsell to over 2,500 additional members. So that visibility of the cash flow over time adds a fourth dimension to just simply growing the number in a pounds and pence sense. So hopefully you can see a very strong, resilient business. It's got diversity in how it approaches an integrated market and a number of different ways to optimize the drop through margin. And on to the next slide, if we look at the cash flow conversion. So again, we've mentioned this previously, but it's adjusted EBITDA post tax. Now, the key number I would draw your attention to there is the DevEx spend. Now, on an annualized basis, that's 1.8 million of DevEx spend. But this is where there's another strategically important part of the Zest divestment. There's roughly half of the development expenditure was done on Zest and half of it was done in our de facto business. Now, the sale of Zest means that we can effectively double the development expenditure in de facto and throw a lot of weight behind new and enhancing the product offering there to our many thousands of members without distorting that number over time. So again, the really strategically important part of selling Zest was to give us that headroom to invest in the core part of the business, being de facto Engage. Now, 81%, it's again mathematically the highest conversion you can have, all things being equal, and that has relied on some working capital inflows across accounts receivable and accounts payable. And what I would point to there is the second bullet point down. An annual run rate is typically about 70%, and that's something that we would consider a sensible long-term run rate. And I guess over onto the final slide from me, before I get a summary, that this is really key for me in terms of controlling balance sheet leverage and risk in the business. When we acquired de facto in 2019, there was a leverage peak of 2.5 turns, and that has come down steadily over time, over a 3-year time period. And you can see there with the benefit of the 13 million of the transactions, it gets us down to just under 0.2 turns. But the real point there is we haven't just delevered the business on the back of a couple of one-off transactions. The business was already deleveraging from its own internal cash generation. And I guess where that leaves us is in a very, very strong position as a business. We've got 18 years of heritage in the market. We've got a membership base in terms of the intermediary segment from IFAs all the way from a sole operator up to the quilters of the world. Over 3,000 members strong. That's got a very sticky, repeatable, direct debit collected membership income. And you can see that core cash generation flows through to giving us significant financial resources. Now, we've got a 45 million revolving credit facility out to 2024, and that gives us significant firepower in terms of additive acquisitions. And we've got a strong M&A appetite, and substantively utilising that facility would take us just up to 2 tons of leverage, which we can again demonstrate gets rapidly paid down. So there's a very strong return on cash flowing through the business. And I guess to sum up from me then, if on the next slide, Matt, thank you. If I work from the top left, again, a really robust financial performance in quite unusual and unprecedented times, a very resilient business model. We continue to increase the revenue quality in the core business through that mix of repeatable recurring software as a subscription type license income, greater visibility of future cash flows. The strong cash generation flows through to just creating significant financial resource and opportunity in the business that we do pay a small but progressive dividend in terms of shareholder return, but the vast majority of the financial resources are reinvested to grow the business both organically and through an M&A pipeline. And I'll hand over to Neil now to give us a bit more colour on some of the strategic initiatives we've undertaken.
That's great. Thanks, David. Thanks, Matt. So you've heard about our business sitting right in the heart of retail financial services and connecting the people who make the products with the advisors who process the products and the consumers who buy them. And we've got really strong brands and massive scale in each of those customer markets. And it sits on a connected platform. So we're gathering data and using those data and workflows to feed that value up and down the market. We've made some pretty incredible progress so far in 2021, and that's because we carried a lot of momentum from 2020 when we set our minds to digitize the business at a rate of knots. During all that disruption, we were really clear about how we were going to create value at Fintel. Indeed, in December last year, we held a Capital Markets Day, and you can still go onto our website and watch that. You'll meet more of the team, see some of our products, and hear some great customer testimonials. And we set out a very clear agenda about value creation and the things we were going to do. And this year we've got busy and got on and done some of those things. I'm going to give you just a couple of updates as part of these interim results. The first area of progress has been with the financial institutions we work with. A great part of our business, and for 15 years we've worked with many of these organisations, every household name that you can probably think of. In 2021, we've started moving the financial institutions from a fixed annual package that repeats every year to a monthly recurring service that is multi-year. And this new way of working with financial institutions means we're in constant dialogue with them about what's happening in the market. We've created a new digital portal so that all of these big product providers can come, log into their Fintel platform, get up-to-date information on the market and the competitive positioning of their products, and then they can use that information to distribute their products more effectively. We think the service is going to be really popular. We've already converted some flagship clients across at the beginning of this year: Schroders, BlackRock, Aegon, Guardian and BMO, you can see. And we're going to be spending time the rest of this year and into 2022 and beyond converting all of these fantastic financial institution customers we have over onto this great new service. This is an example of us delivering one of our CMD objectives, the Capital Markets Day objectives we set out. It's enhancing the quality of our earnings by moving as many of our services over to recurring revenue at margins that increase with great cash flow conversion through digitization. So I think this has been a fantastic development for the sector and for our customers, and it further strengthens our business in the direction we set out. Second, we disposed of a non-core asset. Again, we messaged this really clearly at the Capital Markets Day. Zest is a good business, but it doesn't feed our platform. We don't have the network effect of it contributing to the other values in the business and the other propositions in the business. Zest has been pretty flat growth and not very profitable, whilst consuming quite a lot of development expenditure. So we messaged a while back that we were going to look to dispose of this at the right time, and I believe that this has been the right time. We've generated shareholder value from the transaction with a full price for the business, and more so, it's freed up management time and that development expenditure going forward, so we can put all of our efforts onto the core platform where it belongs. So a good result for two reasons. And third is the strategic deal we've forged with Tandem Asset Management, which is a listed fund management business. The deal itself is worth up to £13 million and represents 2% of the assets under management of the funds business they've purchased from us. So the headline's okay, pretty attractive. The reason we've done this deal, though, and what excites us about this deal, is what we can do on top of the core deal itself. And this partnership will see up to 2,500 of Tatton's customers on board to our core fintech platform. So we're getting a massive extension of scale right on our core technology, more and more financial advisors using our workflows and consuming our investment research and product research, which is going to drive up the value of the services we provide to the sector as well. It's a 5-year minimum partnership with a minimum of 1.4 million per year SaaS fees paid quarterly in advance, so a great cash profile. And over time, we're going to be able to add additional software sales into this partnership, and Tandem will be using our distribution platform. So as we provide them with more data and engagement with the market, our fees will grow further above this base deal as well. So we believe this is going to create significant value, and it's put a Fintel flag at the centre of the sector. We intend to do more enterprise deals like we've done with Tandem, where they've bought our platform, fintech, research, distribution insights and data, and then the delivery mechanism to take products to market and to build new products in the future as well. We've traded really solidly at the beginning of the year, and we've made this progress strategically towards the medium-term objectives. And these were set out at the Capital Markets Day in December last year. Over the next couple of years, we'll achieve 5 to 7% revenue growth at 35 to 40% EBITDA margin, with 70 to 80% of our revenues coming from SaaS and subscriptions. That's where we're driving the core business, growing quality earnings for shareholders from a business with an unrivaled platform, doing really important things for really high value customers. And the continued digitization of our business is how we're going to unlock this potential as we go forward. We've traded well in the first 6 months. We're in line with expectations, and we've made strategic progress in line with our Capital Markets Day promises to shareholders. And we're very confident of the outlook, confident of meeting the full year expectations and positioning the business well to be on track to hit those objectives in the medium term. It's been an absolute pleasure to be able to come and talk to the Mello attendees again, and thank you for your time. David, great to see you again as well.
Yeah, well, great. That was excellent. Quick question from me before the audience ask anything. Did Tatton come looking for you, or did you go looking at Tatton and think it was a good link-up?
We've known each other and known of each other for a fairly long period of time, and we were in talks maybe for quite a few months about how fund managements, how they add value, and they're a brilliant fund management business, and how technology and data is how we add value. And maybe we've got bits of stuff in the wrong place, and it was a great partnership to set up.
And someone in the audience is asking, do you have any other acquisitions in the pipeline in the short term? Probably an awkward one for you to answer, really, that one. But
I'll pick that one up, David. We have a constant pipeline where we're looking at great businesses with a view to either working with them, working in partnership, acquiring them. And so that pipeline is constant, it's active. And as David said, we have a really good facility, RCF facility available, and we're very used to acquiring good businesses and paying down debt. But right at this very moment in time, you know, we've not got anything on the blocks, so to speak, today. But we're always looking out for great companies.
yeah. And yet you're already a young team. Sometimes investors worry about a change in FD. Maybe you could give us a little bit of an insight to that one.
Yeah, I mean, we are all three a relatively young team. And David joined about 5 months ago. We had a relatively long search to find what we believe is the best fit for the business, best fit for the management team, and someone with the right level of experience. So David was at Smart Metering Systems when it was a £300 million business, up to £1 billion business. So on the next part of the journey that we want to embark on, David's got some real experience and skill set and understanding of how to move the businesses forward. So I don't know, David, do you want to add anything to that?
I think you've answered it very well. And again, I just point to the hallmarks of Fintel as a really strong, resilient business with a lot of potential. That was a really attractive proposition for me as I came to the end of a 5-year cycle at Smart Metering System. So again, a great pleasure to join a terrific management team.
Yeah, and having been to $1 billion once, you're obviously hoping to get there again.
Please don't ask me to put a time scale on that, but yeah, it would be lovely.
Yeah, and there's a question here for you, David. Leslie asked, what's your #1 priority for the next 6 months?
Is to drive operational performance into the business, to be honest with you. We previously reported the segments at an EBITDA level, and that required an allocation of central costs. And, you know, it's me just bringing with a bit more experience as to what shareholders, particularly high growth shareholders, are looking for, and to give that clarity and that quality of the going around the market and presenting the results. So it's to drive operational and financial performance throughout the business to grow, because there's those 4 strings of the bow. And again, from SMS, where it had long-term RPI linked contracts, is to bring that mindset of revenue quality that, in fairness, is already here in terms of the Capital Markets Day, but you know, that's my heritage, and I want to drive that through the business with Matt and Neil.
Another Dave here, he asks, do you consider the valuation division core to the business? And if not, are you considering a disposal whilst the property market is booming?
Yeah, great question. And we have called out the valuation business before as being non-core to the business. Again, it's another great business. And for a valuation business, it actually works on relatively good margins. It's a good business. But it doesn't fit with the rest of the business. So we have a wonderful network effect sitting at the middle of Fintel, where we're providing fintech and creating data and selling data. And it doesn't work with the rest of the business. So we will be disposing of that business at some point. I guess, you know, over the last 18 months haven't been the right time to look at selling a valuation business, particularly last year. And as you can see from the presentation, you know, we've had a lot of things to do in the first 6 months of this year. So when the time is right and the market is right, and we believe we can deliver value to shareholders, we will look at the disposal of that business.
Now, Peter asked, with almost 70% of your core revenues now coming from SS, AS, SaaS, of course, and subscriptions, where do you realistically expect this to get to, and over what time frame?
Great question, and I think that's it's a combination answer from Neil and David, really.
I mean, I'll go first. I mean, it's clearly in the Capital Markets Day in December 2020, we painted a picture of out to 2024 to grow that to between 70 and 80% in terms of driving revenue quality. And I think as the question quite rightly points out, we're well on our way to deliver that. And you know, again, we would always look to keep on pushing that boundary, but again, 70 to 80% is a sensible mix in terms of the product offerings we deliver. Neil?
Yeah, absolutely, guys. And the sort of lower end of that range is in sight as we develop new products and we look to evolve the existing products we offer. This is a key focus. So I think our ambitions will be up towards the top end of that range over the next 2 to 3 years. We think it's really additive to quality.
That'd be good. And hopefully you'll be back to tell us you've achieved it all, which is always good to keep in touch with the investors. Thank you very much. That wraps it up. And
thank you.
Good luck with it all, and see you again soon, all 3 of you.
David, thank you for hosting us again, and we'll be delighted to present in front of your investors again next time around. Thank you.
Great. Thank you.
Pleasure.
And here's Alistair.
David, it's great to be here.
Another familiar face, of course. Alistair's been with us a couple of times in the past. Always good to see you. How are Aquis doing? You're going to tell us all about the exchange.
Good, very good indeed. I'm here to present the interim results. So let me just get this up to make quite certain that we've got in front of you. Hopefully you can see that now. Is that
Yeah.
right, David? You can see. Good. Well, look, what I want to do is I'm going to go through the half-year results till the 30th of June. We are pretty pleased with the performance, but those of you who don't know Aquis, I thought I'd start off by saying, look, we're one company. We're a quoted company, Aquis Exchange PLC, market cap around 200 million. We operate three divisions. The original division, which is of Aquis Exchange. This is a platform that trades the top 1,700 stocks in 15 different European markets. We operate under an MTF license, both here and in France. We are the 6th or 7th largest exchange group today, with a turnover of about 2.2 billion euros a day. That's single counted, so that's about 4.4 billion to our customers. We last year bought the Next Exchange, which is now rebranded to the Aquis Stock Exchange. So I'll give you an update on that. We are changing the primary markets in the UK. We think there's never been a more important time to bring the public back into public markets and make absolutely certain that we get proportionality and appropriateness. So companies that decide to raise capital can raise that through the retail market and the institutional market, but be in a way that is much more proportional without lowering standards. And then we have the Aquis Technologies group. Now, with Aquis Technologies, we did a proof of concept with Amazon Web Services and the Singapore Exchange. That has really revolutionized the way of cloud technology in the exchange space. And we're selling that on a SaaS type model. And I'll update you in a few minutes about how that's progressing. So in short, strong financial performance. Last year was all about making our maiden profit. This year, EBITDA tripled to 1.6 million for the first half of the year. This business now is all about execution. We've continued to grow the core business. We've continued to grow the membership. We've continued to grow the trading volumes, and we still believe we've got a long way to go, which is, a huge opportunity for us. We've made significant progress with this primary market, the Aquis Stock Exchange, by changing the rules. And just to finish off by saying that we are absolutely in line with market expectations. We have 3 analysts now covering the stock. So as I said, it's really down to the execution. We've got a clear vision of where we want to be. And I think when you look at this chart, you look at this slide, and you can see the 4 boxes on the right-hand side. Today, we have 22% of all the liquidity in those top 1,700 stocks across Europe. Now, that makes us one of the largest exchange provider of liquidity outside of the national exchange in their own market. And the way we calculate that is we look at every single stock which is in the major indices. You look at the bids and the offers, you take millions of data points, and Aquis owns 22%. So in one way, that looks at what is the ability of us to build our market share. Can we get market share to 10%, 15%? Well, today we have the capability of getting it to 22%, and I believe that will continue to grow. The box next to it is actually what is our market share. This is the amount of business that we actually execute out of the whole of the European market. That last year ended at 4.7%, the second quarter this year up to 5.8%, and I'll show you in a minute how that broke through 6% in July. We've added new members, but I think what is really important, you look at the number on the bottom right, this 27%. 27% of more message traffic. Now, why is that significant? Because message traffic actually builds market share. And as you know, we operate a subscription model. Now, that means to the top clients, when they pay a top tier price, so in other words, just like a telephone company, you pay a particular tier depending on the number of messages. We don't charge by value or number of shares. We charge by the messages that are there. We saw message traffic grow 27%. We saw market share grow. We saw membership grow. And that is with a backdrop of the half year where we actually saw a decline in the market by 13% of turnover. So what this clearly tells me is that not only can we grow our business in a declining market, but actually people are really starting to understand what the subscription model means and are taking advantage of it. Maybe it's my Scottish ancestry, but the marginal cost of zero when you reach the top tier has incredibly significant benefits. This here just shows the market share. When we floated the company, we were just over 2% market share. As I said, in July, we reached 6.2. I don't believe there's any reason why this momentum will slow down. In fact, if anything, I think it can increase, and we can absolutely see ourselves getting north of 10% over the next few years. And as I said before, even higher than that. Here's the evidence of proof of each market. The horizontal line shows the liquidity that we provide. The bar actually shows what the market share. And you can see that in all our competitors here, there is a sort of you can see that that horizontal line more or less equals where the actual market share. In the case of Aquis, this is the paradox. We know that we need more members. We know we need to get more clients up into different tiers and using us more. And that's why I think our market share, it's a clear indication here that our market share can grow. So if we look at the numbers, I said before, we increased our EBITDA to 1.6 million, 3 times more than it was this time last year. Our profit before tax was 1 million. Last year, we were break even. We grew our exchange revenue by 33%. We grew data by 187%. Our licensing is a decline, and I will tell you about that. It's all about timing. I think that business is going incredibly well, and I'll explain in a minute why. But actually, our revenues in total grew 37% year on year. Now, our expenses grew by 17%, and that is because we strengthened our executive team. We hired a new CTO last year. We've hired a new finance director to strengthen alongside the chief financial officer. And we've also hired a new chief revenue officer because we believe in investing now is the right time to scale up the opportunity that's in front of us. The other thing that's important on this slide is out of profit comes cash. There is great cash generation here. We have cash reserves now sitting there at just under 14 million. Every time we're making a profit here, we expect that cash to increase. In fact, as you can see here, the quality of the revenue is incredibly high. 89% of our revenue, because of the subscription model, is recurring. 7% of that is transactional, 4% of it, and I'll explain why we have the deferred revenue, and this is really down to do with accounting of software sales. This shows that we can still invest as a result of the cash generation that we've got. What it'll say that here is that £388,000 worth of investment that we made in the first 6 months of this year, and we will continue to invest out of profit, but never at a point in time where we will exceed the revenue growth, which, as I said, this year, or the first 6 months, was at 37%. So if I look at the 3 different business units and the 4 different revenue streams, the 4th being data, let's quickly go through some of those. The Aquis Exchange, this is the platform business here. It's going very well. We're going to give you a little bit more detail, which is we have 39 members. 9 of those members are in the top 3 tiers. Those top 3 tiers are £80,000 a month, £50,000 a month, £30,000 a month, depending on your message traffic. But we have 25 members who are still in the bottom 5 tiers. Now, just think of the maths here, why we love this model. You just take 5 of those customers. The highest of those bottom tiers is 15,000. You get 5 of those clients by focusing, evidencing the quality of our data, showing best execution, showing the deep liquidity. And we can move 5 brokers into, say, 1 of them in the top tier, 3 of them in the middle tier, in the second, and 1 into the 3rd tier. That would give you about £55,000 a month instead of 15. That literally means that those 5 customers would give us £40,000 a month more. That's 200,000, £2.4 million onto the bottom line, 100% margin. It's 100% margin because our system capability is there. There's no additional costs if we can drive this business. So it is really about focusing on not just bringing new customers in, but getting the banks, the brokers, from the lower tiers up to the higher tiers. And that's why we've hired the chief revenue officer. Technologies, it looks as if from a P&L point of view, that's slightly weaker, but the technology contracts are material. We're talking here millions of pounds. And these contracts are often 3 years, 5 years. They take maybe a year to negotiate. What I can tell you, and this is what I'm allowed to say, is that we have made very, very significant progress on a number of material contracts during these 6 months. But because of IFRS 15, we can't say exactly when the revenue recognition for that will be. And that is because in a technology contract, we can only recognize the revenue at the point of distribution to the client, the point that it actually starts to work in a client's office. Sometimes that can take 6 months, 1 year, 18 months to do. But we have made very significant progress following the fact that we did this proof of concept about cloud technology in the exchange space. And we have a number of those contracts, which I think is very exciting. So do not look at those numbers as a declining number. It's merely a fact of the revenue recognition. The Aquis Stock Exchange, tremendous progress. Everybody knows what we're trying to do here. I've talked in the past about creating the school of stock exchanges. We strongly believe that companies are very much like children, and that children, when we educate them, start at a primary school, they have a different way of learning. We send them to the secondary school, a different way of learning and different proportion, something that's appropriate for them. We give them homework, and ultimately we put them in university where they do self-learning. They behave differently, and that's the process. The problem with the United Kingdom is we actually take 4-year-olds and we shove them into university because we don't have the right proportionality. We don't have the right appropriateness for the regulation. And what we've done at Aquis is create and segmented the markets, not by lowering standards, but by making it easier to get capital to SMEs at an earlier stage. And that, I believe, is strongly supported by the government, strongly supported by the regulator, strongly supported by the Treasury, etc. We need to find ways to get the United Kingdom in a post-Brexit environment to be able to get capital through the retail market and the institutional market. And the stock exchanges, us, the primary market within the London Stock Exchange, they should be focused on finding ways of making the primary market the first port of call, the public markets, and not the last. And that is what we're changing. We have over 50 companies looking to come and IPO on Aquis over the next year. Just to give you some more details, I'll flick through that. There's over 100 companies now there. We've got 20 sectors represented. Market data, very, very briefly on market data. We grew that by 187%. We did that because we harmonized the stock exchange business, the Aquis Stock Exchange, with the exchange business. We don't charge our members data fees, but data is an incredibly valuable business. We'll monetize the stock exchange by the number of companies. As they grow, their data becomes more valuable. But for us, the key here, and for shareholders to look at, is what happens if a consolidated tape is brought into Europe. And if you look up, for those people who want to learn about consolidated tape, that's what they do in America. The consolidated tape, the data in America, is half the price of what data is in Europe. It is ridiculous what stock exchanges charge customers for the use of that data. If we get data in Europe, and we believe the consolidated tape will be pushed through in the next 2 years, and I can say that because that's the latest thing coming out of the Commission, and the various bodies actually in Europe are pushing for this now. If we get that, it is a material change to revenue in the future from Aquis. Happy to talk about that later on, but data can become a fundamentally important number directly into the bottom line. And data to produce, we produce data today already. So this is a very, very high margin business. Now, I know that I only have 20 minutes, so I'm going to finish for David here, but I am a mad, passionate person on old cars. I think we are very much like, unlike my own cars that sit in a garage, here we run 4 businesses. There are 4 cylinders, and I believe we're truly firing on all 4 cylinders, unlike the cars that I have at home. We have a strong team. We have a great technology. All that side is growing. We are going to continue to invest in our business. We have the core principles of technology, transparency, and innovation, and we are tracking exactly where we expect to be at this point as a growth company. At that point, I'll open it up to any questions that you might have.
Great, thank you, Alistair. I'm not sure if it's a question or not that we've got in the Q&A box there, but Peter says he hated homework. You must have mentioned homework somewhere.
I did, and actually, that's absolutely right. Let's bring proportionality and let's bring the appropriateness of what a modern market should look like, and not bring back traditional ways. And that's what we're trying to do.
Now, Paul here is asking, which analysts cover your stock? What are the recommendations and target prices?
Well, I can tell you our stock trades today around about £7 a share. We have 3 analysts now covering us. Libram are our nomad, so they have a stock price setting. I think it's at £8.50. I think they've just readjusted it to that. We've got Panmure's who cover our stock, and that's a £8 price. And I think we have Canaccord who have just over £10.
And how has the share price been moving? Has it been fairly steady or?
Well, it's been pretty good. I mean, we listed at £2, whatever, 2.60, something like that. We saw the price go up. It ran away. It went up to £5, came back to £3. I think just over a year, we're up pretty close to 100%.
That's very good. Very good. And do you expect IPOs to be mostly crypto and cannabis, or are we going to have?
No. I absolutely don't. I think if I look at the 50, 60 companies, yes, we'll have some digital asset companies. Yes, we'll have, cannabis companies. We're not against cannabis stocks at all. But what do we have in the pipeline? I've got e-learning companies. We've got music businesses. I've got industrial businesses, smart factory businesses. I'm just trying to think. I mean, some of these things, electric vehicles, hydrogen vehicles. There's a lot of things that are very, very exciting. What we do need, and where we have a big problem, and your participants here can really help us, is to make this work, we have to have retail. Yeah, the expression I say all the time, get the public back into public markets. That can only happen if the online brokers connect. Now, this time, when I spoke to you last time, AJ Bell and others hadn't. They have done now. It's great. You can put Aquis Stock Exchange stocks in ISAs and SIPs. You can do it with Barclays. You can do it with Jarvis. You can't with Hargreaves Lansdown. And, we need Hargreaves Lansdown, Interactive Investors, Halifax. If you have accounts with those, our companies are performing better, we think, than a lot of companies on national exchanges. And yet the retail market is not allowed access because these people just don't understand what we're doing. They don't like necessarily to see change. And I think that's wrong. We believe, and ShareSoc did a survey, 83% of people want access to all assets that are quoted. And it's a quoted company. These are high standards. We're a recognized investment exchange. We have the same status as the London Stock Exchange. We operate in the same way. We have HMRC approval. We have no stamp duty on our stocks. We have inheritance tax relief, all these benefits, and the retail market should allow access. So if you have an account with Hargreaves, please write to them and say you want access to Aquis.
What excuse are they giving, Alistair?
Oh, I could show you emails which are, you're not a regulated market, which frankly, I shouldn't say this because I think we're still in children's hour, but it's bull. They say that HMRC don't approve us. Well, I can show you the law that states that Aquis Stock Exchange is recognized and approved by the HMRC. I had one yesterday which said, oh, there's settlement issues. And I said, well, what are the settlement issues? We clear through Crest. And when they responded to that, they said, oh, well, we meant that we've got to get approval from Crest. I said, well, you're Hargreaves Lansdown. You must have approval. I get unbelievable excuses, which are just factually incorrect.
Yeah, they're just floundering then, really.
Yeah, and customer demand changes people's opinions. So everybody on this call, many of you will have accounts with Hargreaves Lansdown. All I would say is, if you've got it, Hargreaves, Halifax, Interactive, call, because they will change. I absolutely guarantee these people will ultimately change. And
threaten to move to another broker is probably the best way for them to approach.
It takes what? 15 minutes to move your account if necessary. You can do that.
Yeah, one member of the audience here says just move to AJ Bell if they've already given you the ability to do it. And
I did it myself. I moved my account because I got fed up. I'm not sitting around waiting, and I now have my account with AJ Bell.
Yeah. Great. Well, unless there's any more questions, a reminder to the audience, put them in the Q&A box and I will ask them for you. Nothing coming through. Well, Alistair,
David, thank you. Thank the audience. It's always great fun to be here, so I really appreciate it.
No, and as you mentioned, you've got some good companies. We had Samarkand come along to give us a presentation. We're always happy to have the Aquis companies on the show.
Certainly bring along a few more for you. Thanks very much indeed.
Thank you.
Cheers.
Take care. Bye. Great. Well, here's Andrew and here's Alan. the AA team. Well, I think the first thing we need to explain to everyone is we're going to have a little fireside chat between the three of us, all shareholders and very happy shareholders in Tandem. I know we've mentioned Tandem before on the show, and we did have Jim Shears, the CEO of Tandem, a few months back, come along to do a presentation. Unfortunately, they've just had the results out, but they've got a board meeting today, so Jim couldn't come back on the show. They've also had a broker note out, which is a first for Tandem, I think. I don't remember one. I've been a shareholder for 15 years nearly, so it's great to have some research out there, and in fact forecasts for the next 2 years. I think we're going to share the broker note as well, and a target price. Just remind me, Andrew, what was the target price they put out there?
I think it was 865, wasn't it?
865. It's currently 575. So yeah, we think that one's hopefully doable. We'd all be very happy if it is, but that might not be the end of it. So maybe, Alan, if you want to take us through what you thought of the results and where you think the company's heading. You're on mute, Alan. That's it. You're on mute. Great.
Yeah, I think, again, I mean, there's a lot to say about this, isn't there, really? I think, again, people might know the background to Tandem, which has been a business that's actually made a profit every year going back to 2008. But all that time that Dave has been a shareholder, despite that record of consistent profitability, the shares have generally languished around £1 to £1.50 sort of level. And really, they, I think, rightly had the reputation of being the most difficult board for shareholders to deal with. I remember David and I going along to an AGM about 3 years ago, didn't we, in Castle Bromwich, under the old board structure. Yeah, and I must admit, I was just in disbelief about the way we were sort of treated. And yeah, I mean, they're extremely difficult, and there was certainly no broker research, no interaction with investors. And therefore, I think that was a key reason why the shares languished at an incredibly cheap valuation on the fundamentals. So it's a business that's always been profitable. It's got net cash on the balance sheet. It owns freehold property. It's, you know, there's a lot to like in terms of the fundamentals. And you certainly the last 4 years or so, it's been really growing strongly as well. So it almost ticks every box as an investor in that regard. And yet the real sea change came when the old chairman stepped down. A group of shareholders, which includes David and I, actually took out the biggest individual institutional shareholder, which is Jupiter. And a group of us basically took their stake over, a sort of 10% stake. And therefore we were in a better position to sort of really try and agitate for change in the whole way they interact with investors. And I think, yeah, the broker note that came out at a couple of weeks ago was an important further step in that journey. So I actually interviewed Jim Shears on Mello about 3 months ago, and that was the first time that they'd done anything like an IMC or a Mello or anything. It's the first proper interaction they'd done in that way with shareholders, and you know, I thought they were absolutely excellent. So I think now they are a board transformed in their outlook in terms of how they deal with us. And, you know, they're sort of incredibly helpful. You know, if ever I send an email to them, they always reply really quickly. They almost couldn't be more helpful, the polar opposite of what they were like before. And I see the broker note coming out now as probably a final step in that journey. So say, long may it continue. Yeah.
What were your impressions when you saw the broker note?
I think, you know, it was a good note, isn't it? 29 pages long. It does a good job as well. I think in conjunction with their RNS, actually, it does a good job in properly segmenting the business down to its component parts. Because again, I think going back for all the years that we've known Tandem, they wrote these quite long rambling RNSs talking about all these different bits and sub-brands in the business, and you had no idea what the scale of each one was. And it was really difficult to sort of form a proper picture of what the component parts were that made it up. And I think the broker note in itself was a was a well-written, very worthy effort, to be honest, in terms of,
Yeah.
you know, I think we now got a much better understanding of, right, bicycles is about 30% of the business. We know that toys and sports are about 20%. There's the e-mobility element. You know, we can segment it down properly into all its component parts and see how they're all performing. So it's just added a lot of clarity, I think.
Yeah, I mean, it's got a lot of detail about all the brands. They have a lot of brands, a lot of value in the brands. And of course, you know, it's all in one note, so people don't have to go hunting. Anybody new to the company, because we all know the company, but lots of investors will want to get to know what they do and how they operate. It's all there. And never before we had any forecasts either, and there's forecasts in this one, which is also useful. And a price target, which is equally good to see.
So, yeah, I mean, again, it's interesting, the current rating, it's very clear to us now, isn't it? The rating is on this new forecast, which you're seeing for the first time. It really puts into focus. This is on like seven times earnings as a forecast. They forecast in 72p, aren't they? So it's only around 7 times earnings. And given the cash they've got on the balance sheet, net cash, and the freehold property they own, if you adjust for that as well, it's an incredibly cheap rating. So I think that was the benefit of the note, really. It really flushes that out and makes it very clear to everyone just how cheap this is.
Yeah. How does it compare to others in the sector, shall we say? I know there's character groups, sometimes it's compared to. I don't know if the broker note covers some of the competitors.
They say something about it in the note, don't they? They say the peer average. I think on the front page they talk about, I think 12 times EV to EBITDA is the sector average. And actually, if you put Tandem on that, I think that's how they've derived this price target. It's not a number they've picked out the air. I think they've just looked at the peer average on EV to EBITDA, I think, and then applied that to Tandem, which is say it deserves to be on at least an average rating, I would think, given the growth and the performance of the business.
Yeah. I mean, the share price has moved up a little bit since this came out and the results were received, but it seems to have slipped back down again. I know the markets maybe have not been quite as favorable, but you could argue that it should be going a lot closer to that target price with all the information that's out there.
No, I mean, to me, I think that the big thing, I was having a quick review it again just before we came on, actually, and I think the real standout thing for me was really, if you step back and we can say, well, they're only on 7 times earnings, isn't that incredibly cheap? But it's actually to conjecture what would those earnings have been had they not suffered all the sort of supply chain issues that that we've got going through. And the standout figure for me was them saying the forward order book is now around 30 million, and a year ago it was 12 million. And again, without all the sort of freight problems in China and all the stuff we've read about that's affecting so many businesses, you know, that the demand is obviously more commensurate with a much higher sales number. And without those supply chain issues, you know, we could have easily seen another 10 million on the sales this year. And potentially that's another 3 million profit. The profit could have been 60 or 70% higher than it is. And I think the point about that is it's not business that's lost, it's just delayed. It's now in the order book to come through, you know, I would guess more next year and maybe the year after. I think, you know, it's particularly acute on bicycles, isn't it?
Good point. Yeah. Yeah. In fact, the peer group were available there. There's quite a lot of them that if you just go back again, there's the peer group that they show. And I think it's a very good point that, you know, as with quite a few of these competitors, they will have a big backlog of orders now. And so that means there's a fair bit of certainty for the next couple of years. This isn't something that's been gained in lockdown and is going to disappear overnight. We're going to have a couple of years at least of very good orders to fulfill. How do you feel, Andrew?
Hi guys. Well, yes. Looking at the note, if you go back to the, could Andrew take us back to the projected EPS forecast on the note that the broker did? I'm fairly sure that for the current year, the EPS is forecast at about 74p, which looking at the interim, which was up 50%, and we know that turnover is up 14% up to the end of August. That looks to me like there's some significant uplift in that figure, which quite rightly, this is what a broker's note should be. We should hit the target and exceed it rather than underperform. But it looks very light to me. I've got penciled in 90p for the year, 74.7p there, adjusted EPS.
Yeah.
Which, you know, is way too low on what we know, and we've only got a little bit of the year left. Most of it's already in the bag. I'm baffled that these shares can still be picked up. You know, starting with a 5. We've been as high as 7. They've slipped back a little bit, but the business is worth 30 million. There's, as Alan said, there's 18.5 million pounds worth of assets, 5.8 million, probably a little bit more of cash. They've already invested the 50% of the 1.5 million for the land that they bought, which they bought very cheap. They paid 2.85 million for the 3.23 acres of land. My guys up here are telling me that would be near a 4 million now in the current market. So there's a revaluation to come in there. You know, the downside, of course, is the cost of building the new warehouse is going to exceed the initial 3.5 million projected cost, but 50% of this is going to be financed from net cash, of which as Alan touched on, you know, there's a big cash pile there. The business is in a transformation stage, I believe, because the bit I really like is the B2C part of the business, where the revenue this year was 14% up at the interim stage to 4.2 million. This is the direct to consumer part of the business. That's where I see the growth coming when the bicycle boom in a couple of years' time flattens off. I can see that we could be very, very easily turning over 15 or 20 million a year. With significant cost savings as well, because I think if I was running the business, I'd be looking at consolidating it possibly onto one site and bringing some cost savings in by doing that, and having it all on the Castle Bromwich, the Birmingham site. Wonderful opportunities, and I'm just fearful that if we're not careful, we may attract a bid, and I think that was mentioned in the note. If we're not careful, because the shareholding is, you know, we've got one big shareholder there, and you know, ourselves with a 10 or 12% stake between a few of us, but we are wide open. There's a lot of shares out there in the market, and the share price really does need to respond to this excellent business that the current management are looking after and doing a great job in developing.
Yeah, I mean, I do wonder whether it would be good. We know we have a long tail of shareholders. It's historic. From when they took over a company about 20 years ago, they had a really long tail of people who only held sort of £50 worth of shares effectively. And, you know, now, even though the share price has gone up, they probably still only hold, you know, a couple of £100 of the shares. They're getting dividends that are £1.22 or whatever. It seems crazy to have them on board. They probably don't even realize they've still got the share certificate in their bottom drawer. So I think a consolidation would be good. And then, you know, we would be able to take those shares into treasury. And I do hear that there are institutions now that are starting to look at us, because it's a good place to be, of course. And you know, we took the shares off Jupiter. They were in an ecology fund. We took them off them at exactly the point when probably they should have been investing in them. So it's, you know, not necessarily has to be done, but I think a good way of getting institutions involved, because they want scale. They need to see that it's going places. They want a big stake, and that would be to mop up the tail that's doing nothing, sitting there idle, not really helping us at all, costing us money to service almost.
Indeed, indeed. But I mean, just looking at that adjusted PE on those forecasts there, I mean, you know, 7.1 falling to 6.8 in 22, and that's based on the very low EPS forecasts. But quite rightly, the first broker's note, the last thing they're going to do is give a target that's too high. Better to break it and smash through that. But I can't see us being anywhere near 74. We were up 50%, made 32p in the first half. We made 46p, I think, was it, Alan, in the second half last year? Was it 46p?
Yeah.
So if you put those two together, if without any growth in the second half, you'd be above the 74. And we know that we're 14% ahead. And, you know, that drops down dramatically. If you look on the interim, the revenue was up 14% at the halfway stage, but the operating profit was up 33% from 1.5 to 2 million. So with an EPS increasing 50%. So the operational gearing drops it straight down into headline profit. And you know, I think, you know, well over 80, possibly 90p, depending on how the shipments go, and if we can get some of this product in. And it is tough out there at the moment, getting containers and freight issues. We seem to get over one hurdle, and then we have another one, whether it's an energy crisis or whatever. But they're not going to be hit too hard with that, because they're not producing or manufacturing here in the UK. So, you know, that's one cost that that we're not going to have to bear. It is freight, and it is getting the product into the country.
Yeah, we've got to remember that when this broker note was done, I'm sure management were right in the middle of all the supply pacing issues, and they probably didn't want anyone to get too excited. So the idea really is, your first broker note, I remember Mervyn Keane, the old chairman, said, why do we want any targets? Why do we want any forecasts and broker notes? It only sets us an extra problem that we've got to meet. So I'm sure this broker note going out, they'll want it to be easily beaten. They won't want it to be something that they've got to worry about.
Huge upside, David, though, isn't there? £3.
That's great. That's what we want.
Just to get there, you know, there's £3, even for somebody coming to the party now, to get to the broker's note, that we're all in agreement we should exceed. So, you know, it'll move on to that. I mean, you know, my personal target was £10 by the middle of 22, and always has been. So we'll see whether we get there.
The only thing that you worry when there's a big gap like that needs to be filled is that nobody comes in with a clever bid and tries to win over management, of course, and try and take us out. But we'll stay. We'll make sure they don't open.
And I think for balance, it's actually quite interesting to discuss one of the issues, which is certainly an issue with Tandem that could be seen as one of the bare points, but for balance, we ought to talk about it. And I think it really comes across in that what's on the screen there. If you look down the 2021 estimate, where you can see the earnings per share, as Andrew says, 74.7p, dividends per share 9p. So it's only given us a 1.7% dividend yield. I think the immediate question is, well, why, if there's cash rich as they are on the balance sheet, freehold property, it really are swimming in cash, even in spite of spending on this Castle Bromwich development, swimming in cash. Why are they only paying, you know, it's an eighth or something of the earnings out in dividends? And the answer is that they have a defined benefit pension scheme, which is one of these pension schemes, like all of them, where they're revalued every 3 years, and the company has to come to an agreement with the pension scheme's trustee to make payments into the scheme to recover the deficit over a period of time. So typically it might be sort of 8 or 10 years. So if Tandem have got a deficit, we don't know what the absolute number is, but let's say it's 5 million. Tandem are paying $500,000 a year into that for 10 years to recover it, for example. And the deal is that if Tandem want to pay any additional dividend out, really over and above what's in here, they would have to make a matching additional payment into the pension scheme. And I think that's one of the things that maybe captures us a bit, and maybe makes a few people with all the dividend yields a bit mean. And, you know, in reality, if you put the pension scheme to one side, I think they could easily be affording to pay out 40 or even 50p out of that 74p out, because let's say they've already got the cash they need in the balance sheet, and it could be returned to us as shareholders. So it's the pension scheme that stops it. And I think, again, the additional interesting thing that's happened even in the last week or so, as we're all sort of seeing quite a lot of the small cap values, share prices have been falling, haven't they, in the last, so I suppose 3 or 4 weeks really. And one of the reasons for that is actually that interest rates and long-term interest rates are going up quite appreciably from where they were, you know, even 2 or 3 weeks ago. I think the 10-year gilt yields moved up from 0.5% to 1% in absolutely no time at all. But actually, in terms of the pension scheme, an increased gilt yield is actually potentially really good news. And if in terms of, because it's an interest rate that is used effectively to discount all the future liabilities of the scheme, every year into the future, it discounts it back to a present value. So the higher that interest rate you're using, the more it brings the net present value of the liabilities down, if that makes sense. So in a way, if the gilt yield really does firm up and carries on going up a bit, as many people think it will, it could be that the next pension revaluation really brings this this deficit right down, and therefore frees us up to pay dividends. You know, I know that there are people who understandably say, well, you know, if it's only a 5 million deficit, why don't we just pay it off? We've got the cash and then we're free to do what we want with the dividends. But to be fair to the company, I understand why they wouldn't want to do that. And the reason is that if you could pay the 5 million in, it could then get revalued in the next, you know, the next triennial valuation, suddenly be a much smaller deficit. But if you paid the 5 million in and it's suddenly moves it into surplus, you never get that money back out again. So I think that's the delicate balance the company have got to play with the scheme. But yeah, but I think the increase in interest rates could really help, and just the fact the company is becoming more and more financially robust, the balance sheet's getting better and better, enables them to negotiate a better deal with the pension scheme all the time in terms of deficit recovery as well.
While we're just looking at possible negatives, another Andrew here points out, what about container costs? You'll probably know about this, Andrew, because you're in that field. He says they're going up, and one recent company had to announce that they'd had a shift from 12k per container to 15k of costs.
Yeah, I mean, that's very true. Costs, you know, container costs, freight costs throughout the world.
And they pass them on, you know.
They have passed them on. If you look that you know, and they touch on that in their half-yearly report, and the great advantage of any business is if you are able to pass on increased costs, and this is where airlines tend to struggle, and particularly at the moment where there's a glut of seats chasing very few passengers. Now, when the market turns round, then obviously it will go the other way. But Tandem have been able to, and we've got the same issues. Companies who we've pre-booked, prepaid for particular goods to be shipped have come back to us and said, look, there's an extra 8% on the cost of this product. It's entirely up to you. If you want to cancel, we'll refund. If you want to take it with the 8% increase, then you'll just send us the difference and we'll move forward. The choice then becomes the end users, the retailers. Demand is so strong that we're all saying, fine, okay, no problem, we'll take the stock. You know, the IBDs are desperately short of bicycles and a lot of the component parts that are coming from the Far East. So we're not having any problem whatsoever. Yeah. The consumer has got a huge cash pile individually following 2 years being stuck at home and having no holidays. So I don't see a problem. I think they've managed this very well.
Yeah, they just want their bites. Anyway, guys, that's great. We've covered the company well there, I think, and everybody can make their own assessment. Good to see you both. And Alan, we'll be seeing you a bit later in the results roundup.
Yeah. I hope we stepped in for Jim at last minute well enough for him.
Yeah, well done. Thank you.
Okay,
great.
Thanks very much. See you soon.
Bye. Okay, right. Now we've got another company presentation. Here's Dorian and Louise.
Hi, David.
Excellent.
Hello, David.
Do you feel we covered that company all right? It's probably one of those things, it's a different way of looking at a company, but always nice. Good. Now we've got another company that's done really well over the last year. Belvoir have certainly been a company well followed by all our Mello investors. We've got quite a few that are invested already. And you're going to tell us all about the recent results. You've got a presentation for us, I think.
Sure will. Brilliant. Thanks for that, David, and thanks for the teaser, the few minutes teaser last night. Just on sort of that point on the share price performance. So last September we're sitting at 151. It's 260 as of today. So it's 72% higher than it was in September last year. 6 months ago it was at 198. So that's 31% higher to 260. It's sort of, I think you mentioned this in the previous presentation, but it sort of slipped back over the last sort of 3 or 4 weeks, and hopefully we'll sort of touch on that through the presentation, or we can touch on it in the Q&A. But good evening, everybody. My name's Dorian, CEO. I'm also here with my CFO, Louise. She's there.
Hello.
I just saw you come off mute, so just checking checking that you're there. We're going to whip through a very short presentation, which we think will last about 15 minutes to 20 minutes, and I'll try and put my foot down, and then we'll open up for questions at the end. We had one question come through last night, which we sort of carried forward, and that question was around, has the share price sort of topped out, or where will growth come from in the future? So I'll try and cover that as we go through the slides. In the sort of larger slide deck, we operate in sort of 3 key markets. So we operate in the mortgage market, we operate in the estate agency field, and we operate in the private rented sector as managing agents for landlords, essentially small buy-to-let landlords. So we look after properties, and we manage over 70,000 sort of individual properties. There are lots going on in these individual 3 markets, so I'll try and touch on them within the next 20 minutes. But within the bigger slide deck, you've got much more information on the markets themselves. We do make ourselves very accessible to investors, as David will support. We have been shortlisted in the last 2 weeks. We've been shortlisted for. We haven't won this, but it's a shortlist for best investor communication at the AIM Awards. I think there are 5 companies on the short list, so we're just one of those. But we do try and communicate as best as we possibly can. We attend retail investor events. We always respond via investor relations. Our point being, if we don't have time to cover something tonight, send a question either across to Dave and he'll send it on, or just straight to investor relations and we'll cover it. We'll definitely respond. Our investor website is different to our property website. It's www.belvoirgroup.com. So that's the website advert. Okay, so quick intro onto the first slide. Got it. So my name is Dorian, 22 years in the property sector, 16 and a half years now with Belvoir. I do have a stake in the business, so I've got 646,000 shares, which I have increased my holding over the last few months. During my sort of service with Belvoir, I've also been on a voluntary basis a director of the Property Ombudsman, which is sort of consumer redress for property. Louise is here with me, 17 years experience on AIM listed businesses and 7 years experience with Belvoir. It's been such a fabulous 7 years, really. I think it's that's a fair description, in that if I wind the clock back 7 years, we had just one brand. All we had was Belvoir at the time. The network was about a third of the size that it is today. We hadn't branched out into a estate agency. We hadn't branched out into financial services or anything else. It was purely a residential lettings business. At the heart of our business, it's a franchise model, and I'll try my very best in the short time to explain how that franchise model works. So, on to the next slide, please, Louise. So who are we and what are we? We are as the slide says, multi-brand property franchise group across 467 offices. I do have two screens here, so please forgive me if I'm looking in two spots. It looks like my eyes are going in different directions, but I'll give you a breakdown of these 467 offices. So we own a few of them outright, not many of them. We currently own 5 of these 467. How the slide is set up, on the left-hand side are our property businesses. I'll explain about the Nottingham separately, and on the right-hand side is our tie with a business called Mortgage Advice Bureau, which is an AIM-listed business in its own right. And I'll explain how the sort of partnership with MAB works shortly. So a quick run through of the brands. Belvoir was our original brand, so it's mainly a residential lettings management business. That's very similar to Northwood. So if I put sort of Belvoir and Northwood together, these are primarily residential lettings businesses. Each one has a franchisee at the heart of each business, so the franchisee has 100% skin in the game. They work extremely hard each year to continually grow their businesses. And Belvoir and Northwood franchisees, in the first lockdown last year, protected 90% of their revenue with their businesses closed. So my point being that we're underpinned by strong recurring revenue. That's what is making us more popular with investors, and that was absolutely tested in lockdown 1, when, as I say, Belvoir and Northwood franchisees protected 90% of their revenue, even during the lockdown period, and that's because tenants continue to pay their rent. We continue to maintain properties and liaise with the landlords and tenants, and the cash continue to flow through our franchisees and then ultimately to us as the franchisor. So most of our franchisees are underpinned by lettings. Newton Fallowell and Lavelle are the other way around. So when I say the other way around, so Belvoir and Northwood, majority of the revenue that franchisees generate in Belvoir and Northwood comes from lettings on a roughly 90-10 ratio. So 90% lettings, which is recurring, 10% estate agency. Newton Fallowell and Lavelle, the other way around, so they're mainly estate agency businesses. Newton Fallowell was our first foray into a multi-brand strategy. That was back in 2015. We retained the founder of that business, Mark Newton. He sits on our board. He's a brilliant estate agent, and he's brought a lot of expertise into our business over the last sort of 5 to 6 years. Lavelle was a business we completed on in January last year. I said to Louise in sort of March that our timing couldn't have been worse, actually, with completing on an estate agency business at the start of just before the start of the lockdown. But actually, as the market became much busier, people emerged from lockdown on a mission to move house, with lots of pent-up demand, and then the Chancellor announced a stamp duty holiday. At the end of all of that, we were very pleased that we had an extra 16 Lavelle offices. Interestingly, when we acquired Lavelle back in January last year, 5 of the offices were corporately owned. So we took those in under our banner as sort of corporately owned. And we worked hard to franchise those offices, because franchising is really what we do. And we sold those offices to people who are working within the offices, so to the branch managers. So it's a really lovely story, and the franchisees who are ex-staff members are doing really well. So they've had a great market. I appreciate you may never have heard of Lavelle or even Newton Fallowell. They are very much East Midlands agencies, and Lavelle operates purely within the borders of Lincolnshire, which is where I'm sitting and Louise is sitting. We acquired another business in July, in sort of March, April this year, called Humphreys, and that particular business was a student lettings business. So similar to Northwood and Belvoir, most of its recurring revenue, but it's student. The partnership with the Nottingham, so we've entered into a partnership with the Nottingham Building Society. We're now occupying 39 of their branches on a concession basis. Quite an exciting arrangement. A month ago, we acquired the mortgage business from the Nottingham. So they previously had 21 mortgage advisors. We've acquired them, and we now offer mortgage services to clients of the Nottingham. There's another part to that that's coming in December, which is a key part of our growth, and that's that the Nottingham have around 50,000 people saving in what's called a LISA account. We will have exclusivity to sell mortgage products to those LISA savers, and in partnership with us, the Nottingham and main mortgage advice bureau. A Beehive Money app, as it's being called, is being launched in December, which will facilitate the sale of these products to these tens of thousands of LISA savers. That's unique in our sector. It's something that we brokered, and we're very excited about that sort of going forward. The mortgage advice bureau element. In 2017, we decided to start selling mortgages through our franchise network and outside the franchise network. We acquired a small mortgage broker called Brook, which was trading as Mortgage Advice Bureau. It was called Brook after Michelle Brook, the founder of that business, who is still on board. She used to work for Peter Brodnicki, who runs Mortgage Advice Bureau. He founded it. He then helped to set up on her own. We acquired Michelle's business. Hopefully this makes sense. We acquired Michelle's business, and that was our foot in the door really with Mortgage Advice Bureau. So in 2017, we had 30 advisors from a standing start. We're now up to an incredible 242 advisors, and we represent 15% of Mortgage Advice Bureau's advisor base. And just to be clear about that, these are our advisors. They're either on my payroll or self-employed as part of our business, and we choose to contract with Mortgage Advice Bureau because they offer us exactly what we need. So just some of the key sort of metrics. So highlights, revenue, this is first half. We announced our results on the 6th of September, so these are fairly hot off the press. So this is first half of this year compared to the first half of last year. So revenue up 41% to 13.8 million. MSF, which you may be familiar with this if you're familiar with franchising, but it stands for Management Service Fee, and that's really the royalty or the percentage of revenue that a franchisee pays to the franchisor for belonging to its network. And in return, we give them website, technical support, technical training, all sorts of things to support their business going forward, including access to acquisition funding, which we've used our AIM listing to help us with, which I'll touch on shortly. So MSF really is our recurring revenue. This underpins our business, and that increased 26% compared to the first half. Pre-tax profit up 51% to 4.8 million. Earnings per share up 36%, and EPS is up 165% over the last 5 years. Interim dividend, we've always paid a dividend, so even at the height of the pandemic last year, back in sort of March, April, like a lot of firms, we suspended our dividend temporarily, but then as soon as sort of lockdown 1 happened, we announced our results in September of that year. We reinstated the dividend, so we didn't miss it. We've always paid a dividend since we floated in 2012. We just put up our interim dividend by 17.6%, which has gone down fairly well. Mortgages arranged up 67% in the first half of this year, which is incredible. House sales up 108% in the first half of this year. The way the broader market performed was that across the UK, comparing the first half of this year against the first half of last year, property sales were up by 103%. So they pretty much doubled H1 against H1. We outperformed the market, and we increased our house sales by 108%. Financial advisors, we've got 221 on here because 221 was where we finished the half year. We then completed on the acquisition of Nottingham Building Society's advisors, which took it up to 242. So why invest in Belvoir as a brief summary, and then if we've got time, I'll jump onto the markets. So we've got 6 brands. We're really passionate about franchising because it works. And I'm thinking back to the lockdown last year. When the lockdown was lifted, it took some of the corporate estate agency chains weeks and weeks and weeks to reopen their chains. The difference with the franchise network is that franchisees are very nimble. Most of them opened their offices within 24 hours of the lockdown being lifted. We couldn't hold them back. That's the sort of magic of franchise. And these people generally don't need any motivation from us as a team. We do motivate them, but they're not reliant on that. They're self-motivated because they own their own businesses. They can't disappear, by the way, and break away from our network. We ultimately own the goodwill of the franchise. And we operate what's called a business format franchise. We had 24 years of unbroken profit growth, which is fabulous. This will be 25 years actually. So we've had 24 years up until the end of last year. I was worried that COVID would ride a coach and horses through my strap line of 24 years when broken profit growth, but it didn't. And in fact, last year we outperformed, we exceeded our pre-COVID market expectations. So last year was a good year for us as well. I've got a very strong team with 12 years average length of service across my management team, and across all of the brands that we operate, we have an MD and a support team within those brands. So on one hand, you could argue, well, that's an expensive way of supporting franchisees. On the other hand, I personally believe that if you've got the right team of people driving a brand and supporting its values and ethos and methodology, I believe that's sort of heavily contributing to our success. We've got a high degree of recurring revenue. It's 56% in H1 this year. That will increase as a estate agency falls back a little bit. As a estate agency is a relatively small part of our business. If you strip out financial services in a normal year, lettings represents 80% of our revenue and estate agency 20%. So we're kind of an 80-20 business. That's changed a little bit this year to 73-27, but that will then sort of move back to 80-20 over the next few months. Diversification, we've proved that we can successfully diversify not just into multi-brands, which we've done successfully, but also into a different core business, i.e. mortgages, and that the mortgage side of the business is a really exciting area for us for growth. As I say, to move from, in 2017, 0 mortgage advisors to get to 240, we've had to sort of recalibrate our ambitions on the mortgage side of the business because we'd reached our mental sort of target of about 250. So it's going a lot better than we expected. And then we have helped our franchisees to acquire their competitors, i.e. to buy small lettings books. And over the last 6 years, we've acquired 8 businesses at corporate level, which includes Newton Fallowell and Brooke and the brands that you saw at the beginning. But on top of that, we've helped our franchisees to acquire 105 acquisitions during that same time period. And we used our listing to sort of make that happen. We came to the market, we raised some funds back in 2015, and then we allowed franchisees to borrow money from us to buy acquisitions, and that's worked really well. It's very profitable for us, and we just keep recycling that cash. It's worked very hard. And I say to do 105 franchisee acquisitions is sort of no mean feat over the last 6 years. So then to sum up, really, we've got strong trading across all 3 markets that we operate in. Our current pipelines of house sales and mortgages, if you compare it to 2019, our pipelines, even now, are about 70% bigger than they were in August, September 2019. So we are expecting, a decent finish to the year. We've already said to the market that we're going to achieve market expectations this year, and we've got visibility of pretty much what we think will happen in Q4. Going forward, we think next year will bring more acquisitions. Our net debt position has been improving every single year for the last 3 or 4 years. And at the end of H1, net debt was sort of 4 million. That's come down even further since the half-year results. We're in a decent position to continue acquiring. We'll grow the mortgage side of the business even further, and we've got strategic partnerships with businesses like the Nottingham Building Society that will further exploit in the years to come. So, 24 years of growth. We're good at what we do, which is franchising. We've got a lot of motivated franchisees, and there are lots of opportunities in our sector for further consolidation. We're a consolidator, one of them, and we can see lots of opportunities going forward. So that's just a summary. If I've got time, and I think I've got time, Louise, what time did I start? What time is my finish? How am I doing?
No, keep going, Dorian.
Keep going. You tell me.
So I think
to be
done
quiet
about
when you're
20
ready
minutes, but
Yeah,
David
good,
says
that's
keep
fine.
going, keep going. Do you want to
I just
pop
want to
onto
touch
the
on the market. So I just want to mention sort of we touched on this last night, David. In the if I look at sort of the 2 main markets we operate in, and I'll tell you what sort of happened. So firstly, you've got estate agency property sales. So if you look at in a normal year in the UK, normally we would see across the whole of the UK, around 1.2 million property transactions. That's about normal, and it's been pretty stable for the last 4 years at 1.2 million. It was more than that prior to the credit crunch. It was 1.4 million, 1.7 million, and 1.5 million in 2005, 6, and 7. But we've been running at about 1.2 million across the UK for the last 4 years. So remember that figure as a sort of normal level. So then last year, because if we normally do 1.2 million transactions in the whole of the housing sector, you would expect in the half year to do 600,000, second half about 600,000. What actually happened in the first half of last year was that because of lockdown, only 400,000 transactions took place, and it was just shy of 800,000 transactions in the second half. Point being that even though there was a stamp duty holiday last year, the number of transactions that happened across the whole of the sector was about the same as the previous sort of 3 to 4 years. So the spike in my mind has happened this year, and what's happened this year is that in the first half of the year, we've seen about 800,000 transactions across the sector. I suspect it'll be another 800,000 in the second half, which will give a total of 1.6 million. As opposed to the norm of 1.2 million. That's how I think the year will pan out. So there has been an extra 400,000 transactions. Apparently, 160,000 of those have directly benefited by a tax reduction because of the stamp duty holiday. Therefore, another 250,000 transactions have happened for other reasons, changes of behaviour, working patterns, fear of missing out, relatively cheap mortgages, and the mortgage market is very competitive. So we're not going to see the same spike next year, but actually there isn't a reason why the market will fall back at all, as long as mortgage lenders remain very competitive with their deals. At the moment, you can look at, and it's the same anywhere in the UK, demand for properties to purchase is extremely high. That there just isn't enough properties for people to buy. So stock levels are very low. In a typical town, there are probably a quarter of the normal properties available compared with a normal period, i.e., let's say 2019. So very high demand, low stock. That means that property prices will probably continue to rise, sort of between 3 and 5% of the general sort of forecasts, but demand remains very high. We're just not building enough. There have been various government announcements over the last few months about sort of investment into new builds, but the targets haven't been achieved previously, and I suspect they won't be achieved in the foreseeable future. The buy-to-let side is slightly different. So what's happened in buy-to-let? I've had people say to me over the years, Dorian, why is the share cheap? And I still think we're undervalued, and that's the feedback that we tend to get from some investors. I think part of that is because we're essentially, our DNA is a lettings business, residential lettings business, with a connection to buy-to-let because we manage properties for landlords. I think there's been some negativity around buy-to-let over the last 5 years, mainly as a result of government policies, such as higher stamp duty for landlords when they enter the sector, the phasing out of mortgage interest tax relief, plus other measures. And what's happened with buy-to-let over the last 5 years? And if I wind back a bit further, between 2002 and 2012, our sector buy-to-let doubled in size. So from 10% of all dwellings to 20% of all dwellings. It fell back to 19% of dwellings in 2016, and it's remained stable at 19% for the last 4 years. So landlords haven't left the sector. They've just been discouraged from entering the sector. And now what we're seeing is rents rising pretty aggressively in most areas of the UK. Rents are going up everywhere. This is at the point of reference, 3.5% in London year to date at the point of reference. Southwest, double-digit growth. East Midlands, where we're very strong, double-digit growth. So unfortunately, now tenants are paying the price of really sort of wider government policy really that's restricted the flow of rental properties. So my point being that demand is very high from both buyers and from tenants. There are around 13 million people renting in the UK. About 4.5 million rented properties in England. About half of those rental properties are with agents. Around half of landlords do it themselves. Normally not very well, may I add. It's a very complex sector. And regulation will get tighter over the next few years. It already is tightening up, and we feel as the incumbent we should do fairly well out of that. So that's just a bit of colour around buy-to-let and a bit of colour around the estate agency. So I think I've covered the markets in a whistle stop. Shall we go to questions, David? I think so. I'm not sure whether you've had any come through. Yeah, we've got a few, and we've got the one from last night as well. So.
Yeah, we've got some questions for you. So Andrew asks, what is the risk from online-only agents that also do rental property?
Yeah, no, it's a good question, and I mean, actually, I've sort of had a similar question for the last 5 years, really. Especially when Purple Bricks IPO'd. And at the time, investors said to me, well, surely, Dorian, the future is online agents. They'll take all your business. But they haven't. After spending hundreds of millions of pounds on marketing, the online-only agents, and whoever described that, Andrew, that's a really good description, by the way, because some people call them online agents, which is a misuse of the word online. We've been online since our inception, so we're all online agents. But the online-only ones have won on estate agency. They've gained a market share of less than 10% collectively. So even though they've spent hundreds of millions on marketing, 9 out of 10 sellers are going to a local agent because they've got a local team of people on the ground. On the letting side of the business, which is the question, the sort of online disturbers, if I can call them that, have had no impact whatsoever, none.
Wow.
I think the main reason for that is that property management requires maintenance, it requires boots on the ground, it requires a network of humans who can visit that property and be at the property. We've got about 2,500 people in our network, 212 on my payroll, the rest either franchisees or staff of franchisees, so you can see the humans that we've got involved. So that was the one. Another one is from John. Dorian, how do you see the future expansion of the business, letting, sales, financial? Also, how would you anticipate funding any expansion? Yeah, again, good question, John. I think it's fair to say if we've done eight corporate acquisitions in the last 5.5 years, and 105 franchisee acquisitions, it's fairly safe to say we're quite acquisitive. So we remain very acquisitive. The number of opportunities has actually been less, even though we've had a brilliant year this year. There have been fewer acquisition opportunities simply because agents are doing very well, so they've been grabbing their profits. They then will come to market next year and expect a higher price for their business because they've got all this extra profit, and then obviously we'll say to them, well, surely that was a spike, for a short period. But my point being that we think there'll be lots more acquisition opportunities. One, lettings actually is growing. At the start of the year, there was a bit of a question mark over sort of lettings growth, but if you strip out acquisitions, we've got underlying lettings growth in the first half of this year of 8%. It's 21% if you include acquisitions. So our lettings business is growing well, and of course lettings is recurring. I've shown you hopefully in the slides that on the mortgage side of the business it's going very well. Just an idea of where to illustrate the growth potential on FS. Only 10% of the revenue we're generating through our 240 advisors, only 10% is coming from our franchisees. 90% is coming from other sources. So on one hand, you could say, well, Dorian, you've completely failed to integrate financial services with your franchisees, accepted. On the other hand, you could view it as just an enormous opportunity, and we view it as the latter, and we're going to spend the next 2 to 3 years integrating our franchisees with FS. Our franchisees have just been distracted over the last 18 months, and they've just chased the money. They've gone after deals that pay them more money as opposed to sort of FS referrals. How would we sort of fund expansion if it was a big acquisition? We at the minute our net debt is at a very comfortable level. We are happy to carry more debt, if we needed to, so that there isn't any dilution. But we have been to the market previously. If it was a really big acquisition, then of course we would come back to the market if we thought that was the best method.
I think the point there, we're very cash generative, and as you can see from the deals that we've done over the last few years, Lavelle and Nicholas Humphreys, we've been able to fund those out of cash that we've generated each year, and so as long as we can use that cash or go for bank debt, we would do in the first instance.
Yeah, good one. So, Belvoir difference with the Property Franchise Group. I mean, ultimately they are just a different firm. They've sort of gone down the route of home run estate agents as well as sort of shop-based ones. That's one point of difference. And also on the financial services side, they're also rolling out financial services, but they're rolling it out as part of a referral scheme with LSL, which is another listed business. As I said during the presentation, our mortgage advisors are our mortgage advisors. You know, this is our business. We've grown it, and we've grown it without the franchisees, which I've had a few investors say to me that they feel very comforted by that, because it means that no matter what happens in franchising, FS stands alone, which it does, and vice versa. So they're just different sort of businesses. We remain, you know, I'd never say never that there won't be a deal between the two businesses. There aren't any talks going on. Never say never, but you know, we have probably diverged rather than converged really in terms of our strategy over the last 3 years. And then another question from Andrew, you know, why would I use one of your franchisees as opposed to Open Rent? I don't actually know much about Open Rent, but I presume it's a sort of DIY type, a generally DIY type service. I'll give you sort of one example. When the pandemic sort of broke last year in March and the lockdowns happened, a lot of DIY landlords who use portals to do bits and pieces for their rental, but they manage the property themselves, were reporting very high levels of arrears. You know, if you manage a property yourself, even though you use a web portal to do certain things, if a tenant stops paying the rent, for example, it can be very emotional, and landlords tend not to have an understanding of the legal framework. The level of arrears across our portfolio didn't exceed 4%, or hasn't exceeded it ever. So, and certainly not during the pandemic. So DIY landlords were reporting arrears as high as 40 or 50% in some scenarios. Our arrears less than 4%. Lettings is very technical. You know, I'll give one last example on that one, is that I went to pick up a new car a while ago from a showroom, and the sales guy said to me, Dorian, you know, I've got a buy-to-let in Peterborough. He said, and I'm going to do it all on my own, you know, with these web portals. I certainly wouldn't need an agent. And I said, well, yeah, it's interesting. Good luck. And what will you do if the tenant doesn't pay the rent? And the landlord, the guy said, well, I'll get some friends and we'll just go and change the locks, you know, and we'll sort of remove their goods and stuff. And I said, well, next stop is the prison, isn't it, really? Because that's a criminal offence. And when you sort of, and he disappeared, and he came back 10 minutes later and he said, do you mind if I have a chat with your office in Peterborough, Dorian, just to give me an option? I think people tend to have quite an old-fashioned view of how you manage a property, but it's a very complex area. If you get it wrong, ultimately somebody could die in a property. So my point is, we don't charge much, about 10% of the rent, tax deductible. So, you know, if your rent's £1,000 a month, an agent might charge you 100. You can offset that against your tax bill. So I don't think we charge very much for the work that we do. It's a 24-hour job.
Yeah. I mean, overall, Dorian, you know, you're currently in a situation where I would say your strategy is to pay out about half the money to the investors back as dividends, and about half the money goes on for onward growth of the company. Do you intend to keep it pretty much that level?
Yeah, do you want to do that, Louise?
Yeah.
And the other question we've had is about share options, which is quite useful.
I can probably cover some of that. So yeah, I think that's definitely the case. I guess when the business floated in 2012, and we still had our founder very much involved, the policy back then was almost like 100% distribution. And then as we started our programme of acquisitions, you know, we needed to retain money in the business to actually, you know, to invest in those rather than keep diluting shareholders through raising equity. So over the course of the last 7 years, we've built up our dividend cover. So we are at a position now where we retain half and pay out half. That keeps a nice balance, because obviously investors want the return through the dividend, but equally they want to see the business grow, and we've demonstrated that we've used those funds that we've retained, you know, pretty sensibly and invested in, you know, accretive businesses. So that we aim to continue that. In terms of how many share options are coming down the track, there's just under 900,000 that are in issue as we stand. None of them can be exercised. There's none that can be exercised until January 2023. And I think it's a smaller, perhaps, you know, a couple of 100,000 or so can be exercised from that point onwards. Probably 650,000 of those were issued at the end of June, and therefore won't be exercised until 2024.
Great. Right, well, that just about covers everything. No more questions there. So thank you both for helping us with all those, and always good to see you. As we mentioned last night, you're also very involved with the help we're trying to give to charities. So that's very kind of you on behalf of Belvoir. We like that. And hopefully next set of results, we'll see you again.
Yeah, that would be good.
Brilliant. Okay, thank you.
Thank you very much. Thanks then. Bye, David.
Okay, now we've got a results roundup for September. Here we go. It's Alan and Kevin, who are always looking at all the RNSs every day. They know quite a few companies around the market. I think, Kevin, you've got a couple to cover and Alan's got 3. So let's start with Alan then, as you've got an extra one. So who would you like to go with first, Alan?
Okay, I think I'll do mine in chronological order, David, of going backwards on updates. Now, I've particularly chosen, out of the many companies we could discuss, tried to pick 3 where we have discussed them on Mello before, they've been on the bashers or they've done presentations, and therefore hopefully the audience has got some familiarity with them, and therefore thought they would be 3 good ones to pick out to discuss. The first of them is Tremor Video, which is, they announced the results actually right at the end of August. And they are a programmatic advertising platform focused on digital video and CTV, connected television. Basically, there were the interim results, and they gave a full trading update for the interims and to take account of they were halfway through their 3rd quarter by the time the results and the update came out. Basically, it was a really stellar upgrade, to be honest. It was the 8th upgrade of expectations we've had in the last 14 months. The EBITDA forecast for the current year was increased by 36% and next year's by 28%. And yet, incredibly, you could buy the shares now more cheaply than you could the night before the upgrade. Basically, when the interim results came out and the big upgrade came through, the shares shot up above £8. But it certainly met some reasonable selling pressure, as often you find with companies who've risen up from, at one stage last year, it was about £1. So it's been a sort of 8-bagger. You always get some people, institutions, wanting to take some money off the table, haven't had such a good run. So I think it's just run into selling pressure, but it does mean that, we've had a big upgrade of expectations with the share price actually cheaper than it was. I think just to talk for 3 or 4 minutes on it, really, it's maybe to start off with what are the bear points on Tremor Video. I think number 1 for me in terms of bear points would be referring to the greatest investor of them all, Warren Buffett, who always says rule number 1 of any investment is to invest within your circle of competence in things you fully understand, which is very sensible advice. But with Tremor, I think the minute you get into this programmatic advertising platforms, optimizing advertising spend, it is beyond most people's understanding. It's a very complicated business. It's complicated to explain exactly what it does and how it makes its money. So it's fair to say that is a bear point, despite their best efforts to try and explain it. There's videos on the website that tries to explain what it does, but it is complicated. I think there's also, because it is an Israeli-based tech firm, the market always seemed to apply quite a big discount to Israeli tech firms, and probably with good reason to some degree. I think a few of them have blotted their copybooks at one time in the past, certainly Plus 500, XL Media, Tremor themselves, that they've certainly done things that the market didn't like at one stage in the last 3 or 4 years. I think also just because it's involved in advertising, it can be an element of cyclicality to it. And at the moment, there seems to be a very strong upward cycle. But again, if the world turned, advertising spend is something people could turn off to try and save some money. So they are exposed a bit to the economic cycle. However, I think the bull point is probably a longer list for me. It is the fact that the current rating is 9 times. Next year's EBITDA is rated only on 9 times EV to EBITDA, when all the American peers are on an average anywhere between 17 and 52. So they're a huge discount in rating. They're in a structural growth market, growing like Topsy at the moment. They've got a very strong balance sheet, forecast to end with over $300 million of net cash at the end of this year, which is about 20% of the market cap in itself. The fact that the rating is so low and hasn't moved in spite of this really big upgrade. It's dual listed on NASDAQ as of 3 or 4 months ago. I think it's also worth pointing out that in spite of this huge upgrade, 36% EBITDA, the forecast, even after that, does look very soft. It's basically looking to double the first half EBITDA, which is 67 million. They're sort of talking about 135 as the forecast for the year. So that all they need to do is double the number. And yet this is a seasonal business that always, every year going historically takes and makes a lot more money in the second half, and particularly the fourth quarter. So I think normal pattern goes through, the forecast looks soft and up for further beats. I think, so overall, my view would be certainly positive on these results. I think it is growing like Topsy. It is very cheaply rated relative to its peers. It's got a cash-rich balance sheet, and there are further upgrades to come, I believe.
Just out of interest, Alan, with all that cash then, why have they never considered paying a dividend?
I think they've always looked to be acquisitive in consolidating. They have done buybacks in the past, haven't they? But interestingly, the cash balance went up significantly as part of this floating on NASDAQ. Actually, that brought quite a big extra cash balance in effectively. So yeah, I mean, they look to be acquiring. I think they've had a good record of buying businesses in and really going through the costs like a dose of salt and really improving them. And I think they see that's the better route with the cash rather than distributing it to shareholders.
Right. Is there one that you've looked at much, Kevin?
We have looked at it before. So I'm looking at my notes. The last time we talked about it was on the 9th of November 2020. So yeah, around about here. And I just simply said, it's Israeli, so no. It's not that it's Israeli, it's not English, and I just have a, you know, I've got a really high barrier to investing.
I think there are quite a few that avoid it for that reason.
Yeah. There are a few red flags, but
maybe floating on the NASDAQ has given it an extra bit of confidence boost, I suppose, from outside. Right, one for Kevin to tell us about now.
Okay, I was going to cover Judges. They released their interims last Friday, so the headlines are all up there. They all look pretty good. And before I start, I should acknowledge, Dave, that you have a soft spot for Judges, because
I do.
It was one of the first companies to present at Mello.
Yeah, I think it was
which was
7th company ever to come to Mello.
Yeah. So
that was in 2009 or 8.
Yeah, 2009, according to my reporter. It says it was, I can't quite get the date, but it was somewhere around about here in 2009 when the share price was at 178.5 pence.
Yeah.
I wasn't clever enough to buy it at 178.5 pence, but I did buy it at about £5 a couple of years later.
Yeah.
And it's been a great performer since. So I would just highlight.
He's so engaging. The CEO, David Sickerell, was always happy to come back to see us after every set of results. Even if the results weren't quite as good as you'd hoped for, he'd still come back and see us. So that's a big tick in the box for engagement, which is obviously what Belvoir are looking to achieve as well. And other companies should try and do it with investors.
So I would just notice this note this particular video from PI World. So if you go to piworld.co.uk, this is an interview about the interim results with the CEO, David Cicerel, the CFO and the COO. And you'll get a lot more useful information there than you'll ever get from me. For those who don't know Judges Scientific, they're focused on the acquisition and development of scientific instruments businesses. So this is their website, and this is a portfolio of their various businesses. Essentially, this is a roll-up model in the scientific instrument sector, but Judges have been doing this successfully for a number of years, and they've really cracked the formula, which is simply to focus on cash. They generate oodles of cash every year. They put that cash to work by buying more businesses to enhance and grow the portfolio. They're always careful about the price that they pay for those acquisitions, so never, generally speaking, more than 6 times EBIT for the businesses that they acquire. And hence, this, you can see here, I mean, just here on this chart, the simple power of compound interest from generating cash, reinvesting that cash. And it's just phenomenally impressive, Lovely increasing revenue, but look at how net profits and EPS are growing at 60% per annum on a post-tax basis. You see the free cash flow is fantastic. There's a brilliant dividend per share, always consistently growing. And then the one thing particularly to note is the thing that really works and that Warren Buffett would love is that they don't use shares to make the acquisitions. So you can see here the diluted weighted average shares has remained pretty much constant throughout all of the time that they've been listed. And instead they just simply, they use debt to make their acquisitions and then pay down that debt as quickly as possible. So just quickly looking at the numbers, these are the recent interims. There's been a lost year of COVID to a certain extent. So these comparisons look fantastic comparing H1 2021 with H1 2020. But H1 2020 was impacted by COVID. And if you go back to H1 2019, essentially the numbers are up marginally compared to then. You can see net debt has dropped down, good organic growth as well as growth by acquisition. And then the key for Judges and for its model, what it needs is they've got this bank facility that they've agreed with Lloyds. They've now got 60 million of spending power to get out there and to start making acquisitions again, because the acquisitions haven't really happened during 2020. The question that remains, Dave, is, do you buy Judges on a forward P of 36? Yeah. And the thing is that Judges is one of those businesses that's always looked expensive. There's a number of them out there. I mean, I was talking to somebody about these the other day, that the likes of Halma, SDI also looks expensive. Avon Rubber, not so expensive because it's had a fall from grace recently. But do you pay 36 times? And if it grows its EPS by 60%, then you can do the numbers and you can work it out that actually the forward PE this time next year would only be 22.5. So, I think Judges will always look expensive and you'll always be scared of buying it, but I can make a case.
Yeah, very, very well run, steady company. Great. And another one from Alan?
Yeah, I thought another company who presented on Mello, and we've discussed them on the Bash relatively recently, actually, RBGP, Rosenblatt. Basically, they had their interims out 2 weeks ago. Very strong results. The sales were up 53% on the first half last year, and actually 35% of that was organic. So they delivered 5.7 million of EBITDA. It was basically in line with, so they left forecasts where they are after this interim update, but they have already upgraded twice this year already. And it's really for two reasons they've upgraded. Number one, that back in May, they acquired a business called Memory Crystal, a really large acquisition they made actually, which is, you know, it's large in the scale of Rosenblatt itself. And so that was a big, strong earnings enhancing acquisition. So those numbers were overlaid into the forecast. And secondly, one of the three parts of the business, one called Convex Capital, which is a supply side advisor, corporate finance boutique who advise entrepreneurs on selling their businesses to large corporates, is like, you know, this activity is extremely high at the moment. We can see a lot of merger and acquisition activity going on in the market. So it's in Convex's sweet spot in advising them. And they are the part of the business that's really been growing like topsy and has got a very strong pipeline of future deals down the pipe as well. So that's driven upgrades as well. So it's an in line with market expectations update, very strong numbers. I think, again, probably bare points with RBGP would be, I think it's a business that's quite hard to get your head around, as well as there's quite a lot to it really, and it certainly takes a lot of time and effort to really understand all the component parts and what's happening with each of them at any point in time. There's the Convex Capital part that I discussed earlier. There is the legal services part, which in itself splits into contentious law and non-contentious law, and has now got this new acquisition overlaid into it. And there's also a litigation funding part of the business, who is almost like a mini Burford litigation capital type business. So there's all these different component parts, all, you know, with different things going on at them all the time. So it's a fair bit to get your head around. And then the second bad point probably would be that it can be exposed to quite lumpy earnings. Sometimes a big legal case might settle and it be a really big source of income, and which, you know, does it fall just before the year end? Does it fall just after the year end? So that sort of lumpiness is part of the territory really with a business, investing in a business like this. However, I think, again, for me, the bull points massively outweigh the bear points, and the big bull points are, I think, first of all, the synergies that you would expect them to get from this acquisition they've made of Memory Crystal. I think they bought it very cheaply and well to start with, but their very impressive CEO, Nicola Fulston, certainly a lady who doesn't suffer fools gladly, has had a hugely successful career. And she's really got the existing Rosenblatt business humming on the very best ratios for everything, really. Fees for partner, lockup periods, margins, and really Memory Crystal is much more in the middle at the moment of all those ratios in terms of all its city comparatives. So I think you'd trust Nicola to really improve all those ratios over the next couple of years. So there's big synergies to come. It's in fact a pretty low rating, only a P of 12 for next year, when the average sector is more like 15, 16. I think that's an unjustified cheaper rating on the basis that, you know, this business has higher margins and is growing faster. So it seems an unjustified cheap rating there. It's a low rating. I think the third big bull point for me would be the Convex pipeline. They've completed 9 deals this year already, having only done 3 in the whole of last year. This year they've already done 9, but they've got the complete pipeline of 36 deals on the go. 2 of them look massive deals as well, that are over £100 million deals. And again, they're saying 9 of those deals are at various stages of completion. So I think we might have hopefully some upgrade to come from Convex either this year or perhaps more likely next year, depending on when these deals complete in full. And I think for me, probably the biggest bull point of them all, to be honest, over and above those ones, is what they call their elephant cases. There are 3 cases where they actually own, and 2 really big ones are due for adjudication next year. The ones they call Shango and Mercury. And the potential payout of those, one is, I think, £65 million, and another one is £75 million. If those cases were won, those would be bigger than the market cap of the whole business in itself. And if you look back at this business, going back to 1989 when it was formed, the success rate it's got on cases is around 86%. So I think there must be a really good chance of one, if not both of those cases, really adding significant value to what we've got at the moment. And they're not in any broker's forecasts. So yeah, that's it overall, I think, very positive.
Great. Thanks for that one, Alan. Kevin, another one?
Yes, the other one I have is Thinksmart Limited.
Oh, not one I've heard of.
Yeah, I was thinking about whether or not this has been covered before, and I actually think it has been covered before once. I think David Thornton from Growth Company Investor mentioned it.
Okay, yeah.
Yeah, and so I'm highlighting this because it's a bit of a special situation. Thinksmart itself is a digital payments business, and in the UK they built this company, ClearPay, and to my mind, you can think of this as an internet credit card. It's a business that extends credit to consumers, and when you get to the checkout, you're offered buy now, pay later credit. So there's various products like this out there on the net. So, you know, you might have seen it with PayPal. PayPal also have a buy now, pay later product.
Mm-hmm.
But the point is that they developed this business and then they've sold it, or more precisely, they have sold 90% of the business to an Australian company called Afterpay, and they've retained 10% of it, and that 10% will be sold to Afterpay in certain circumstances. And this is where we get to the special situation. So, okay. First of all, the size of this 10% relative to the rest of the business it dwarfs the rest of the business. This is what fundamentally, essentially, drives the economics of the share price. And secondly, Afterpay itself is currently the subject of a bid from a larger American company called Square Inc. And that bid would trigger a change in control clause in the various contracts, and thus trigger the contract to sell the 10% of ClearPay earlier. Now, Thinksmart's finals came out 2 weeks ago. And in this, they explain that the 10% shareholding in ClearPay has been independently revalued to 125 million. So just to go back here, the market cap of this business at the moment is just under 112 million. If you scroll down through these results and read them, and there are a lot of nuances in how this valuation works. So if anybody wants to clear this, take some time, because you've got to allow for this factor, then that factor, and this factor. But it does all work out, I promise you. When you get to how they've valued this, they have applied an element of conservatism in here. So they've applied a discount of 17.5% in arriving at the valuation that the directors have calculated. So this 125 million is already at a discount to 17.5% of 17.5%. But add to that, the purchase price in the contracts is linked to Afterpay's market cap, and the market cap that is used in the valuation here was the market cap of Afterpay at that point in time, which is still 10% below the expected ultimate price that's been bid by Square Inc. So taking all of that into account, I am penciling in a cash receipt of 156 pence a share in Q1 of next year versus a current share price of 102.5 pence. Now, management have a track record of paying special dividends and returning funds to shareholders. So I think that the risk that they waste the cash on a frivolous acquisition is low, but there's still that risk there. And of course, there's always the risk that the bid doesn't proceed. And then there's the risk that my numbers are completely wrong. But let me highlight this. This is our good friend Simon Thompson. And Simon Thompson is more often right than he is wrong. So I think we have some faith in him. This is his numbers from the 2nd of August, which was before the valuation from the directors themselves came out. And he did a quick calculation and estimated, he came out at 132 pence a share. And our good friend David Thornton, I'm a subscriber to Growth Company Investor, so this is the blog. You've got to pay to get access to this, but he's recently done his numbers and he gets to 166 pence a share. So look, I think there's a lot of bunts left on the table.
Yeah, that's an interesting little special situation.
Yeah, hence it's a special situation, and hence why I would highlight these particular results if anybody wants to have a look at it a little bit further.
Yeah, good idea. Great. Always good to have these on Mello. And Alan, another final one from you, I guess.
The last one I'll talk about briefly is Spectra Systems, who gave their interim results out about 3 weeks ago now. Basically, we had 2 announcements on the same day. We had the interims themselves, which were very strong, as I'll discuss in a moment, and also a contract win for their authentication product that authenticates K-Cups. It looks like a sizable contract win, actually, which is, they say, is going to build the K-Cup business for them up to around $1 million a year next year at very high margins, which I take to be sort of 80% plus. So it's a very nice contract win, and looks like it hasn't been put into the forecast yet either. So hopefully there's room for upgrades of next year's numbers in due course. The first half Spectra numbers were very strong. The sales were up 23%. The profit before tax was up 47% to $3.4 million. And basically still at this stage, they've kept the broker forecast in line. But Spectra is a business that over the last 4 years that I've been a shareholder, we've had 14 upgrades of expectations without any downgrades. And Nabil Lawandi, who I actually interviewed on Mello about 3 months ago, the really impressive sort of real rocket scientist of a CEO, he's always extremely prudent in the forecasts. And I think if you had to absolutely set your watch by forecasts in the market that aren't going to be missed, then Spectra would be high up that list. So I think very strong forecasts. Basically, I think these shares at the moment, they're only around 150, early mid 150s, aren't they? And really that puts them on a forward P of only around 17 times earnings. And if you adjust for the cash, the cash on the balance sheet they expect to have at the end of this year is around $16 million. And if you factor that in, that's almost 20% of the market cap. So really, like a cash adjusted PE is only 14, which I think is an extremely cheap rating of the existing forecast numbers that are in the market. And I think when you consider those forecasts are likely to be upgraded if the last 4 years have got anything to go by, and I think it's highly likely to happen again. But probably the most attractive thing about Spectra is the extensive pipeline of further opportunities they've got really going out over the next 15 years or so. And they do have the most blue of blue chip customers. It's sort of G7 banks who with them really for, decades. So it really is a sort of very solid business, but they've got these hugely exciting opportunities. Again, if we were doing it as a presentation for half an hour, I could list them all out, but it's obviously a quick 4-minute review of the results. But again, they list out in the RNS all the opportunities, some really big ones. Probably the biggest 2 opportunities that they've got are a G7 bank where they've already got the framework agreement in to supply sensors for that'll be supplied through 2024 to 26, a $42 million contract effectively. And when you look at that, it's going to be again 50, 60% margins. and that would be over and above its core business that we see at the moment. And again, in the context of a 70 million market cap, that's an incredible element of the pipeline. I think the biggest opportunity they've got is probably to develop this absolutely secure polymer substrate, which no other producer in the world is able to produce. And again, that's just at the stage where it's hopefully going to become commercialized in the next 2 to 3 years. And, you know, that could be the thing that could be the massive game changer for Spectra. But yeah, a whole host of other really exciting opportunities. And yeah, I think a lot to love. The downside hugely well protected by a pretty low rating, fantastic balance sheet, oodles of cash, certainly a business I sleep very easily at night owning.
Good. Right, well, thank you both. I think that wraps it up for the results we've covered through September. We will try and do this every month when there's lots of results out. It's a good way of catching up with companies that have been to Mello and new companies as well. It's always good to, Kevin's just highlighted one, it's always good to see opportunities. It's not always the companies that have been previously. And I would just like to say it's a perfect time to do it, having mentioned judges tonight. For those in the audience who've never been to a physical Mello, and I know with the virtual world, quite a few of you haven't, Kevin and Alan actually have been coming for years to Mello when we were in the physical world. Kevin, in fact, was one of the first people I met through the Motley Pool and came to Mello when we were first at Beckenham. I can just tell you all, it's a good thing to note, if you'd attended the first 10 restaurant evenings in Beckenham and just put £6,500 into each company, hopefully if you like them, but if you didn't like them, you might not have done. But if you'd done that, you'd have been a millionaire today, because we had 2 companies that went completely bust out of the 10. We had 3 that were taken over in future years. And we've had 5 that have literally multi-bagged like you've never seen before. So Judges is just one of them. Acesso went on to be a 100-bagger, although it has fallen back. But if you invested in Acesso when they came in 2008, I think you'd still have a 30-bagger on your hands. And the other companies, they're all on our original website. It's just amazing how these small companies can really pay off. And I'm not saying you invest in them all, you must make your own decisions, but there's some good companies out there, and hopefully at Mello we fine tune them a little bit before they get to come and see you. But you know, these days we leave it to you to analyze everything and use your own research. But we've had some good companies over the years. You'll remember most, Kevin, I should think.
You're putting me on the spot, aren't you? Because you can't remember them.
Oh, I can't remember them all. No.
I have the memory of a fish, Dave. If I don't write it down, then that's it. I've forgotten it.
Yeah.
So I'm sure I've written it down somewhere, but you're putting me on the spot. I can't recollect any.
Well, I mean, just Judges is incredible. I mean, Judges, £1.78. It's there in black and white. To £80 yesterday.
Yeah.
You only need one of those in your portfolio. You can afford to have, you know, quite a few that don't do it.
I bought at somewhere around about here, £5-ish into my pension fund, but unfortunately my pension fund was small back in 2012, and so the amount that I bought, obviously I should just put all my money into Judges ideally, but that would have been a little reckless.
Yeah. Great. Well, anyway, just a little way of looking back in the past and seeing what happened. Let's just check if there's any questions here for us. Yeah, Ian actually says exactly the same. He wished he'd put a lot of money into Judges when he first heard about them. Don't think there's any more questions on that. LowQ, oh yeah. Yeah, it was originally called LowQ, Acesso now. That probably was my best ever investment. Can't complain at that one at all. But anyway, yeah. Thank you everyone for being with us tonight. Always good to get your questions. We finished pretty much dead on where we wanted to be, so it's good. had another night together. The next show is on the 5th, I think, 5th of October. It'll be on our website. I say I lose track, so many things going on. But anyway, yeah, I'm pretty sure it's the 5th, Monday, the 5th of October. Then we got a Trust and Funds event on the 11th, I think. Yeah, good. Okay, thank you, everyone. It's good night from Kevin, Alan, and I. And
Right.
have a good evening. There's a little bit of football if you want to catch it coming up, no doubt. Some big matches. Great.